I personally believe that we are in absolute familiar territory this time. If you see the title of Ind AS 37, Provisions, Contingent Liabilities and Contingent Assets, it shall undoubtedly remind you of Accounting Standard 29. You have done AS 29 at the earlier level. The title of AS 29 is also the same, Provisions, Contingent Liabilities and Contingent Assets. The reason why I am saying is that you will find yourself in very familiar territory is because Accounting Standard 29 is heavily borrowed from International Accounting Standard 37. And when AS 29 got converged with International Accounting Standard 37, then we have Ind AS 37. There are minor differences between Accounting Standard 29 and the International Accounting Standard 37. And those minor differences, as and when removed, becomes the converged Ind AS 37. But in case if you do not remember Accounting Standard 29 that well, do not worry. I shall be doing Ind AS 37 right from the scratch. I'm just giving you a little bit of brief up that yes, this particular Ind AS and Accounting Standard 29, there's a lot of familiarity between the two. As usual, we will like to first understand what exactly is the scope of Ind AS 37, what items will be covered, and more importantly, what items will not be covered by Ind AS 37. Okay. Let's go through the scope of the Ind AS. They are saying Ind AS 37 should be applied by all entities in accounting for provisions, contingent liabilities and contingent assets. In a way, you can say that there are three major items that are going to be covered by in this Ind AS. Provisions, followed by contingent liabilities, followed by contingent assets. And then of course, a few extra things are there in the Ind AS. Whenever you are doing any accounting of provision, any accounting of contingent liability, any accounting of contingent asset, you have to apply every entity. They use the word all, okay, all entities. Every entity has to apply Ind AS 37. But certain types of provisions, contingencies are outside the scope of Ind AS 37. Okay. What is outside the scope of Ind AS 37? Let's understand that. They are saying those resulting from executory contracts except where the contract is onerous. Right, the very first thing that we really read and we simply do not know what is it really trying to say. Yes, as we will move further in this particular discussion, we will understand what do we mean by executory contract and onerous contract. Right now, understand Ind AS 37 will not be applicable to executory contracts. But if executory contract becomes onerous, then Ind AS 37 will be applicable. They say those resulting from executory contract, then they use the word except where the contract is onerous. That means when the executory contract will become onerous, then Ind AS 37 will be applicable. Otherwise, it will not be applicable. Okay. Financial instruments, including guarantees that are within the scope of Ind AS 109. Financial instruments. In financial instruments, we have studied about, for example, financial assets, debtors, right? Trade receivables. These are understood as a financial asset. For the debtors, you may recognize a provision for bad and doubtful debts. Isn't it? You do recognize a provision for bad and doubtful debts, but that will be outside the scope of this Ind AS. Financial asset, debtor ultimately is a financial asset, and financial assets are covered by Ind AS 109. Ind AS 109 deals with impairment of financial assets. Impairment of a trade receivable is nothing but recognition of a provision for bad and doubtful debts. I'm not too sure whether you still remember the requirements of Ind AS 109, but that is what Ind AS 109 suggests, right? So go through the financial instruments Ind AS, and whatever financial assets are there, financial liabilities are there for which you might be recognizing a provision, all those provisions are outside the scope of Ind AS 37. And then they say those covered by another standard. There are certain provisions which are covered by some another Ind AS, then that respective Ind AS shall be applicable. Now, which are the provisions and contingencies which are covered by other Ind AS? Let's go through that now. Okay. Revenue from contracts with customers. Now, revenue from contracts with customers will be covered by Ind AS 115. But then they say, however, Ind AS 37 applies to onerous contracts with customers. This word onerous contract keeps on getting repeated. Just give me a little bit of time. We will understand executory contract and onerous contract. But right now, it is important for you to understand that if you are having a contract with a customer out of which you are recognizing revenue, and that contract will be covered by Ind AS 115. Ind AS 37 will not be applicable. But if you come to the conclusion that this contract with my customer has become onerous, then to such onerous contract, Ind AS 37 will become applicable. Income taxes covered by Ind AS 12. You may say provision for current tax. You may say deferred tax asset, deferred tax liability. No such thing is going to be covered by Ind AS 37. They are all subject matter of Ind AS 12. Leases covered by Ind AS 116. What about a provision for the lease payable, lease rent payable, right? Leases are covered by Ind AS 116. You will not apply Ind AS 37. But again, Ind AS 37 applies to any lease that becomes onerous before commencement date of the lease as defined in Ind AS 116. Again, the word onerous contract is getting repeated, isn't it? If there is any lease contract which becomes onerous even before the contract commences, once the lease contract commences, you have to apply Ind AS 116. But before the commencement of the lease arrangement, if a lease contract becomes onerous, apply Ind AS 37. And then they say, short-term leases and leases for which the underlying asset is of low value that have become onerous. Now, you must be becoming very impatient now that why this word onerous keeps on getting repeated. What does that really mean? I told you, give me a little bit of time and we will go through what do we mean by onerous contract. So remember this thing, leases will be covered by Ind AS 116. But any lease that becomes onerous before the commencement date itself will be covered by Ind AS 37. We know that certain recognition exemptions are available in Ind AS 116 for short-term leases and leases of assets having a low value. But if these kinds of leases become onerous, again you have to apply Ind AS 37. Employee benefits covered by Ind AS 19. Ind AS 19 employee benefits. Recall employee benefits, Ind AS. You have to recognize a provision for gratuity payable, recognize a provision for pension payable, right? You are recognizing a provision for the employee benefits that you are going to pass on to your employees. All those provisions are to be recognized as per the requirements of Ind AS 19. They are outside the scope of Ind AS 37. Insurance contracts covered by Ind AS 104. Insurance contract, that's a very interesting thing which is there from time to time in different Ind ASs. We do study about insurance contracts, but Ind AS 104 is outside the syllabus. So we are not going to discuss in detail insurance contracts, but bear in mind, insurance contracts will be covered by Ind AS 104. It will have nothing to do with Ind AS 37. And finally, contingent consideration of an acquirer in a business combination covered by Ind AS 103. Ind AS 103 is business combination. In business combination, when you are calculating purchase consideration, we do include contingent consideration, isn't it? The acquirer promises the acquiree that we will pay you something extra if certain conditions are getting fulfilled in future. As and when those conditions will get fulfilled, extra money will be payable. That's the reason we call it as contingent consideration. In the title of Ind AS 37, we have contingent liabilities, contingent assets, but this contingent consideration will not be covered by Ind AS 37. It shall be covered by its respective Ind AS 103. So that's the scope of Ind AS 37, right? There are quite a few items which are actually excluded from the scope of Ind AS 37. But now it is time to understand, when you say Ind AS 37 will not be applicable to executory contract, I would like to know what do we mean by executory contract. And then they say that it will be applicable if the contract turns out to be onerous, right? The term onerous contract also has to be well understood. Executory contract, I will not apply Ind AS 37, but if it becomes onerous, it will become applicable. Customer, if I'm having a contract with customer out of which I'm recognizing revenue, Ind AS 115 will be applicable. But if that contract becomes onerous, then I have to apply Ind AS 37. You get my point? You enter into a lease contract, it is not covered by Ind AS 37, but before the commencement of the lease contract becomes onerous, then it will become applicable. Short-term leases not applicable. Asset of low value is not applicable. But if these leases become onerous, Ind AS 37 becomes applicable. Hence, I will like to know, what do we mean by executory contract? What do we mean by a contract becoming an onerous contract? First of all, let us understand what do we mean by executory contract. Executory contracts are contracts under which neither party has performed any of its obligations, or both parties have partially performed their obligations to an equal extent. You have just signed a contract. We know in a contract, two parties will have reciprocal promises. One party will promise one thing and the other party will promise something else. Normally, the other party's promise will be consideration. So one party is promising to deliver a good or deliver a service, and the other party is ready to make the payment for them. There shall be a delivery of consideration. Neither party has performed any of their obligations. We will consider that contract to be an executory contract. Or both parties have given performance of their obligations but partially, and again importantly, to an equal extent. Okay, think in this way. Let us say you are joining at my place for the purpose of coaching. Let's put it in this way. Okay, now you have not attended a single lecture, right? You have only signed up that yes, on so and so day the classes will commence, and you have said that I will be joining from that particular date. We will consider this contract right now to be an executory contract. I have not performed any obligation. You have also not performed any obligation, isn't it? And that's the reason we say it's an executory contract. Okay, now look at the other part which is there. Both parties have partially performed their obligations to an equal extent. Equal extent does not mean 50%, 50%. Okay, equal extent does not mean that. Think now in this way. I have completed 20% of the syllabus and you have paid 20% of the fees. Okay, we have decided that this is going to be the final fees. Okay, I have given performance of 20% of the syllabus. I have completed. I tell you that 20% syllabus is completed. You say, okay, this is 20% of the fees. The contract will still be considered to be an executory contract. Why? Because both the parties have partially performed. I have not completed 100% syllabus, so I cannot say full performance is given. That means the contract is partially performed. You have not paid 100% of the fees. That means you have also not given 100% of the performance of your obligation. But we have done it equally. I completed 20%, you paid me 20%, and that's the reason we will say it is an executory contract. But what if I have completed 20% of the syllabus, but I have already collected 100% of the fees, right? That's what most of the times happens. You have already paid 100% of the fees, while I have only completed 20% of the syllabus. Then this contract cannot be considered to be an executory contract. If this contract becomes onerous, let's say, then Ind AS 37 will become applicable. So here Ind AS 37 is not applicable, here also Ind AS 37 is not applicable, but it becomes onerous, then it will become applicable. So please understand the executory contract meaning when neither of the parties have given any performance of the obligation, or both the parties have given partial performance but to an equal extent, we will say it is an executory contract. We do have one example of an executory contract, and I believe that will make things very simple and very crystal clear. On 1st April 2021, A Limited enters into a contract to supply 900 units to B Limited over a period of 1 year. Okay, A will supply the units and B is required to make the payment of the agreed consideration. Okay, when you are entering into this contract on 1st April 2021, just see, 1st April 2021, A Limited has not delivered any units and B Limited has not made any payment. Come on, today itself we are signing the contract. I'm telling you that, see, over a period of 1 year, I'll supply 900 units. You are like, fine, this is exactly what I want. Okay, but I have not delivered any units and you have not made any payment. Neither parties have done any performance, right? Neither party has performed any of its obligation. I will consider this to be an executory contract. Okay, ask yourself, is this contract onerous? If your answer is yes, apply Ind AS 37, otherwise not applicable. Okay, what happened on 31st August? A Limited has delivered 300 units. B Limited has made payment for 300 units. Contract is for 900 units. Partial performance is given by A Limited and partial performance is given by B Limited, but both of them have partially performed their obligations, but to an equal extent. Okay, both parties have partially performed their obligations to an equal extent. This will again make it an executory contract. What has happened by the time it is 30th November? A Limited has delivered 700 units. B has made payment for 500 units. Total units to be supplied were 900. 700 units have now already been supplied. That means performance is still pending. Okay, performance for A Limited is still pending. But if you look at B Limited has not made payment for 700 units. If B had made payment for 700 units, then again it will become an executory contract. But here what has happened is both parties have not performed their obligations to an equal extent. I have delivered 700 units, but you have made payment only for 500 units. For the remaining 200 units, which I have already supplied to you, now there is an obligation on your part to make payment for the same. Okay. B Limited is required to recognize a liability for the 200 units for which it has not paid. But more importantly, it is no longer an executory contract. And because it is no longer an executory contract, in any case, Ind AS 37 can become applicable. But once again, if the contract is turning out to be an onerous contract. We have to also further check that whether this contract is going to be covered by Ind AS 115. If the contract will get covered by Ind AS 115, then again Ind AS 37 will not be applicable, right? So one has to really check over here. But then the intention of this particular example was not to understand whether Ind AS 37 is applicable or not. We want to understand what do we mean by an executory contract. And we realize over here that in the last instance, it does not turn out to be an executory contract. But yes, instead of 500 units, if I say here 700 units, okay, B Limited has made a payment for 700 units, then it is no longer an then it is indeed an executory contract because both of them have given equal performance. What if B Limited has made payment now for all 900 units? Okay, then also it will not be an executory contract. I hope you are comfortable with the meaning of the executory contract. But then we are constantly saying that what if the executory contract is onerous, then Ind AS 37 will be applicable. What do we mean by an onerous contract then? Okay, let us understand what do we mean by an onerous contract. An onerous contract will be understood as a contract where your committed costs will exceed the benefits. Situation like cost of contract is greater than benefits of contract. This is a situation where we will consider the contract to have become an onerous contract. You know that in order to give performance of the contract, I will have to incur an expense of 10 lakhs, but the other party will pay you only 8 lakhs of rupees. Your committed costs are greater than the benefit to be derived from the contract. Consider that contract to have become an onerous contract. Of course, you will counter argue that why will anyone enter into this kind of a contract? See, when you signed up for the contract, it was not really in that way. Right now, you estimated the contract cost. You are of the view that I'll have to incur an expense of 6 lakhs of rupees, and against that, I'll get 8 lakhs of rupees. You consider it to be a very profitable contract, and that's the reason you have signed up the contract. But in the contract, there is no escalation clause. As you commence the performance of the contract, all of a sudden the costs have increased. And because there is absence of escalation clause, I am not able to pass on the increased cost to my client. What I had originally estimated at 6 lakhs will now take me 10 lakhs to complete the contract. But the promised revenue will remain 8 lakhs of rupees only. Your committed cost is exceeding the benefits to be derived. Your contract has become onerous. If the contract becomes onerous, Ind AS 37 becomes applicable. Doesn't matter. Is it an executory contract which is becoming onerous? I have to apply Ind AS 37. It is a contract with customer for revenue covered by Ind AS 115, but it becomes onerous. I have to apply Ind AS 37. It is a lease contract, but it has become onerous before the commencement of the lease. I have to apply Ind AS 37. It is a lease for a short-term duration or a lease for a low-value asset, but the lease has become onerous. I have to apply Ind AS 37. Onerous contract is a theme which will get covered again and again in this particular Ind AS. Getting it? If you just read it now, they are saying an onerous contract is a contract in which the unavoidable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under it. The cost that I will have to incur to meet my obligation is exceeding the benefit that I am going to receive. I will say my contract has become onerous. Ind AS 37 is applied to executory contracts only if they are onerous, right? I sign the contract today, and before I provide any performance, before you provide any performance, the contract becomes onerous. I have to now apply Ind AS 37. They've given an example also. A long-term purchase contract that has a higher unit cost than the unit selling price. Let us say I am a trader. I will buy from you and I'll sell to a third party. I have entered into a committed contract to buy 100 units from you at 10 rupees. And with the other party, I have entered into a committed contract to sell at, let us say, 11 rupees. Okay, but it is a long-term contract. It's a long-term contract. Insofar as you are considered, you have an escalation clause. But as far as I am considered, I don't have an escalation clause. You get my point? I'm going to buy from you. You can pass on the increased cost to me. But I also have a contract to sell to a third party. To that person, I don't have an escalation clause where I can increase the selling price. 1 year down the line, let us say, the unit cost is increasing. What you were selling to me earlier at 10 rupees, now you are selling that to me at 12 rupees. I have to pay 12 rupees to you. But to my party whom I have promised to sell at 11, I don't have an escalation clause. So I'm not able to increase the selling price. I will have to now buy from you at 12 and sell at 11. The contract has become an onerous contract for me. And if it is an onerous contract, we are going to apply Ind AS 37. Well, the title of Ind AS 37 is Provisions, Contingent Liabilities and Contingent Assets. From the title itself, it is becoming clear that guidance will be available in Ind AS 37 on these three matters. Let us start with the first one. Let us understand what do we mean by provision, when shall the provision be recognized, and if it will be recognized, how exactly will it be measured? Right, that is what we will like to know. That is the full guidance when you say with respect to provisions. You know, one of the easiest way of understanding provision is to understand provision as an accounting estimate. We know that when we are preparing our financial statements, there are a lot many matters for which you will have to make estimates. You will come to know what is the actual expense, but only in future. But I cannot wait till future because the financial statements have to be finalized right now and not in future. And that is the reason certain accounting estimates are required to be made, and accordingly a provision needs to be incorporated. You know, that is exactly what a provision is. It is a liability which timing is uncertain. It is a liability whose amount is also uncertain. Those kinds of liabilities we can understand as a provision. You can even understand provision also as an accounting estimate, right? We say a provision is a liability of uncertain timing or amount. I am selling on warranty basis. I am promising my buyers that, see, in the next 3 years, if the product develops any manufacturing defect, you can bring the product to me and I will repair it at my own cost. Okay, I am selling the products on warranty basis, as you can see over here. Now, certain proportion of the products may develop manufacturing defect. I do not know when those manufacturing defects will be developed. There is an uncertain timing over here. And if at all manufacturing defects are developed, how much will it cost me? There is an uncertain amount over here. The provision that I will recognize for warranty cost is a liability of uncertain timing or amount. Getting it? There is a pending lawsuit. Certain clients have taken me to court. They are dissatisfied with the work that the company has done. Okay, when will the court's judgment be out? Uncertain timing. And if at all I lose the case, then what is the amount of damages payable? Uncertain amount. This is also nothing but a liability of uncertain timing or amount. I can consider it to be a provision. A provision shall be recognized when all three below mentioned conditions are fulfilled. All the three conditions are fulfilled, then we have to recognize a provision. Okay, do not consider provision as some future expected loss and for which you are supposed to make a contingency accounting. No, it doesn't really work in that way. Okay, we are not applying the principle of conservatism over here. Principle of conservatism: ignore the future probable gains but provide for future probable losses. That's not how provisions work. Three conditions are there. All three conditions are fulfilled, only then you can recognize the provision. Here it is, A, B and C. This is representing three conditions. All three should be fulfilled. If all the three are fulfilled, go ahead and recognize a provision. Okay, let's understand each of these conditions one after the other. They say an entity has a present obligation. Obligation can be legal or constructive. That is a result of a past event. An entity has a present obligation. Now, what do we mean by present obligation? By the word present, we mean right now. You must have an obligation right now. But more importantly, let us say you are finalizing your financial statements on 31st March 2022. On 31st March 2022, you are preparing your balance sheet. For the year ended 31st March 2022, you are preparing your statement of profit and loss. Ask yourself, are you having an obligation on the reporting date? If you say yes, that means you have a present obligation. One of the easiest way of understanding a present obligation is that you must have obligation on the reporting date. After all, provision will be recognized on the reporting date. And if you have an obligation on the reporting date itself, the first condition gets fulfilled, provided the obligation is as a result of a past event. Of course, it will be very natural. If you have an obligation right now, that obligation right now will not be on account of something that will happen in future. You have an obligation right now only because something has happened in the past. If you come to the conclusion that on the balance sheet date you don't have an obligation, but on a future date you will have an obligation, then the first condition is not getting fulfilled. Getting it? Obligation which will arise in future does not satisfy the first condition. First condition is you must have a present obligation. Okay, and it has to be on account of some past event. They also use the words in bracket legal or constructive. Okay, let's discuss at a further length. Yes, a past event that leads to a present obligation is called an obligating event. Earlier we were discussing, right, provision for warranty basis. You are selling goods on warranty basis. The action of selling the goods, that's the past event. And because of that, on the balance sheet date, you have an obligation. that in case if the goods are returned to you because they develop manufacturing defects, you will have to incur the repair expense. Getting it? So here there is a past event. The past event is the event that you sold on warranty basis. We took another example that there is a pending lawsuit, right? The past event is that the customers, your clients, have filed a case against you, right? This is what we understand as an obligating event. An event that has occurred in the past is giving rise to a present obligation. I will say it is an obligating event. Now this obligation can be legal or constructive. Okay, yes, here before that we'll just complete obligating event. They say an obligating event is an event that creates a legal or constructive obligation that results in an entity having no realistic alternative to settling that obligation. Right? Something has happened in the past because of which you have an obligation as on the balance sheet date, as on the reporting date, and there is no way in which you can avoid it. You have no other realistic alternative except settling that obligation. As I said, the obligation can be legal or constructive. Let's understand the terms now further. When can we say it is a legal obligation? When can we say it is a constructive obligation? A legal obligation is an obligation that derives from a contract through its explicit or implicit terms, legislation, or other operations of law. Getting it? You may have a contractual obligation. As we were saying earlier, you have sold your products on warranty basis. You have given a warranty card to your customers. There is a contract over here. The contract may explicit, the contract may be implicit, doesn't matter, but a contractual obligation is there. I will consider that to be a legal obligation, or it may be on account of legislation because of a statute. Okay, so statute is saying that so and so provision will be required to be recognized. For example, there is a statute for environment protection, right? Your what I can say, let us say your unit is throwing all the pollutants in a nearby river. All the pollutants are released in the nearby river, but the river requires to be cleaned up at regular intervals of time because there is an environmental law which is asking you to do this. Not only you, even the other companies which are in the vicinity, everyone has to contribute towards cleaning up the river. Getting it? So there is a legislation over here, and the legislation can give rise to an obligation. As on the balance sheet date, are you polluting the nearby flowing river? The answer is yes. And because the answer is yes, you are under an obligation to clean up that particular river. The action of polluting the river is the past event, or we can say the obligating event, and the obligation to clean up the river is a present obligation. It is a legal obligation arising out of the legislation. Or it can be because of other operation of law. Right, there is a pending lawsuit. The court will order sooner or later that so and so amount of damages are payable, and I will have to pay those damages. This is another operation of law because of which damages will be payable. I shall consider this also to be a legal obligation. Then what is a constructive obligation? Yes, that is interesting. This is something new. What do we mean by constructive obligation? Think in this way. I am not legally bound. I am not legally bound, but still I may have to recognize a provision. Those kinds of provisions can be understood as a constructive obligation. Constructive obligation means we have promised something and the other party now has a valid expectation that we will discharge those responsibilities. Then for those responsibilities, you will have to recognize a provision. A constructive obligation arises from the entity's actions through which it has indicated to others that it will accept certain responsibilities, and as a result has created an expectation that it will discharge those responsibilities. That is what we understand as a constructive obligation. Let's take an example to understand this. Let us say in your factory unit there has been a small accident, and 2-3 workers have been injured and they are hospitalized. Okay. Now the company feels that because this accident happened during the working hours, the company wants to bear their hospitalization expenses. Getting my point? An accident occurred in your factory, your workers got injured, they are hospitalized, and the company will now pay that bill. Okay, the company makes this announcement that we will bear this particular expense. You are not legally bound to do so. There is no contract with those workers. Actually, they are casual workers. They are daily wage earners. Every day I employ them, and every day at the end I pay them their wages, and my contract comes to an end. My contract is only for them to work. Nowhere I have told them that if there will be an accident, I will bear the expenses. Okay, so there is no contract. There is no legislation also which requires me to bear this expense. There are no other operation of law also over here. There is no legal compulsion for me to do so, but I feel that I am responsible. I'm not responsible for the accident, come on. I am responsible for the upkeep of my workers. This is what I feel as a company. And that is the reason on moral grounds I'm making an announcement that this is an expense that we will be bearing. Just see, there are entities actions over here through which it has indicated. Please read this again. They are saying there are entities actions through which it has indicated to others that it will accept certain responsibilities, and hence now there is a valid expectation on the part of the others that these expectations will be discharged. This is a constructive obligation. I will have to recognize a provision. Of course, if all the three conditions are getting fulfilled. There is an obligating event over here. The event is the announcement that I made. And because of that, as on the balance sheet date, I find myself to have a present obligation. Getting it? So the first condition that needs to be fulfilled for the recognition of provision is that the entity has a present obligation. Present obligation, understand present obligation as an obligation as on the balance sheet date. The obligation can be legal, the obligation can be constructive, and it is because of a past event. Okay, it is because of a past event. Okay, condition number 2. It is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. They've used the word probable. It's a very interesting word that they've used over here, and we will have to really understand what do we mean by the word probable. Before that, we look into the condition. It says it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. When you will settle the obligation, right? In part A or in the first condition, we say there is a present obligation. When you will settle the present obligation, there shall be an outflow of resources embodying economic benefits. What that means is, it is not necessary that this particular outflow of resources will be only in cash. It can be any type of economic benefit, but it is going outside the business. That is what we say here. Outflow of resources embodying economic benefits. And it is probable. What do we mean by probable? Ind AS 37 understands the word probable as more likely than unlikely. More likely than unlikely. Statistically, right, we are measuring probability over here. Statistically, we are measuring the probability. If the probability is greater than 0.5, or in terms of chance, we may understand this as 50%. Okay, if there is a more than 50% chance that there shall be an outflow of resources, we will say that the outflow of resources is probable, right? They say probable means more likely than unlikely. That is, probability that the event will occur is greater than the probability that it will not occur. Statistically, one can argue probability is greater than 0.5. That same example that we had taken earlier. You are saying that your clients have taken you to court. Okay, and because of that, you may have to pay the damages. Now, the lawyers are saying that 40% chance is there that you will have to pay damages. 40% chance that I will have to pay damages. When I will pay damages, there shall be an outflow of resources. But what is the probability of that outflow of resources? 40%. That means the probability is 0.5 or less. The moment the probability is 0.5 or less, that means it is not probable. And if it is not probable, I will not recognize a provision. I hope you are getting my point. Right, outflow of resources is the event. Probability of occurrence of this event is less than the event not occurring. The moment you say 40% chances there that you will have to pay damages, that means 60% chances there that you will win the case. If you will win the case, then you are not supposed to pay the damages. If you don't have to pay the damages, there will not be any outflow of resources. That means outflow of resources is not probable. If the outflow of resources is not probable, no need to recognize the provision. Getting it? But in that same case, my lawyers are saying that be prepared. 70 to 80% chances there that we will lose this particular case. 70 to 80%. That means there is a greater than 0.5 probability for outflow of resources. I will satisfy the second condition. Am I satisfying the first condition? Is there an obligating event? Is there a past event? Yes, my clients have taken me to court as the past event. Do I have a present obligation? Yes, the lawsuit is pending. I have a present obligation. Will there be an outflow of resources? Yes. And is it probable? More than 0.5 probability is there, because 80% chances that I may lose this particular case. And that's the reason I will recognize a provision. Getting it? That means the second condition is also getting fulfilled. Yes, let's look into the third and the last condition for the purpose of recognition of provision. A reliable estimate can be made of the amount of the obligation. Provision is required to be recognized in our accounting books. If you have to recognize a provision in accounting books, then an accounting entry has to be recorded. You cannot record an accounting entry if you do not know the amount, right? So it is necessary that you can reliably estimate the provision. My lawyers are advising me, that same example, my lawyers are advising me that be prepared, you will lose the case, 70% chances that you will lose the case. I will ask my lawyers that if I will lose this case, how much will I have to pay by way of damages? Then they tell me that based on certain past cases, we are of the view that you may have to pay 10 lakhs of rupees. I will recognize a provision for 10 lakhs. There should be an reliable estimate possible for the amount of the obligation. Without an estimation of the amount of obligation, I cannot recognize a provision. Getting it? So all three conditions are getting fulfilled. Just see over here. Past event, my clients have taken me to court. Present obligation, there is a pending lawsuit. Lawyers advising 80% chance you will lose the case. That means the outflow of resources and boarding economic benefits is probable. And my lawyers are saying that around a lakh of rupees is what you may have to pay. A reliable estimate for the same. I am selling on warranty basis. The action of selling the goods on warranty basis is past event. Present obligation is there that by chance if the goods develop manufacturing defects, I will have to repair at my own cost. Condition A fulfilled. B, when I will repair it, there shall be an outflow of resources and boarding economic benefits, and it is definitely probable. I know from my past experience that around 3 to 4% of my goods do develop manufacturing defect. That means outflow of resources is probable. And finally, can I estimate the amount of repair expenses that I will incur reliably, not accurately, but reliably? The answer here also will be yes. From my past experience, I know that what kind of defects normally develop and how much cost I have to incur for the same. There is a company which has a policy of refunding for goods which are purchased by the clients and the clients are dissatisfied by the same. You are selling this particular goods with a promise that if you are dissatisfied, you can return the product within 7 days. Okay. The past action over here or the past event over here is that you are selling goods by promising your customers that a refund will be available. Present obligation, yes, there will always be certain number of customers who will be dissatisfied by the product, and that's the reason there shall be a present obligation. But you have made it very clear to your customers that you will provide refund not in cash but by way of a credit note. Understand? They are buying from your store, you will give them a credit note of your store. You will suggest to them that, see, this particular credit note means the next time when you make a purchase, so and so amount will be deducted. For example, a customer has purchased goods worth rupees 5,000, but the customer goes back to his home and is dissatisfied, returns the product the next day. 5,000 will not be returned to the customer in cash. We are giving them a credit note, and this credit note may be valid, let's say, only for 1 year. You tell that customer that, see, within 1 year you can encash this credit note. Next time when you buy anything worth 7,000 rupees, 5,000 rupees will be deducted by us. You will have to pay only 2,000. Getting it? I just want to know whether these conditions are getting fulfilled or not for the recognition of the provision. You sold on goods by promising a refund. That's your obligating past event. Present obligation, certain customers may become dissatisfied, hence there is a present obligation. Issuing a credit note is an outflow of resources embodying economic benefits. Getting it? That's the reason earlier I was saying that it is not necessary that it has to be only in cash. A credit note here is not representing an outflow of cash, but it definitely is an outflow of economic benefits. Next time when that customer will buy something, we will get 5,000 less. You get my point? You will get 5,000 less, and that's the reason there is an outflow of resources over here. Is it probable? Answer is yes. My past experience has shown that certain number of my customers, they do become dissatisfied by my products and they do return it. Can you make a reliable estimate? Yes, you can definitely make a reliable estimate for the same. Everything will be on the basis of your past experience, isn't it? All three conditions are getting satisfied. I should be recognizing a provision. Let's discuss further for the amount that is required to be recognized. After all, an accounting entry is going to be recorded by the amount that is to be recognized, isn't it? They say amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. Provision will be recognized on the reporting date. On the reporting date, make a best estimate. For example, the manufacturing goods will be returned back. The manufactured goods will be returned back if they develop manufacturing defects, isn't it? I have to make a best estimate of the repair cost that I will have to incur. So that is how I will recognize a provision for the warranty expenses. How will I do it? That's the question. Similarly, my lawyers are advising that I may lose the case. What will be the amount of damages that I'll have to pay? The lawyers will examine that in the past similar kind of cases have happened. Yes, what has been the court judgments over there? How much damages have they really asked the other party to pay? On the basis of that, we will estimate that what are the damages that will be payable by us. Getting it? We are making a best estimate. You will not get an accurate figure. Accurate amount will be available in future. When the court will pass the judgment, I will get the exact amount. When I will actually incur the repair expense, I will get the actual amount. But I cannot wait till then. Accounting has to be done today, right? Accounting has to be done today for those expenses for which we have already committed as on today. And that is the reason estimate is required to be made. What I am doing is I am making a best estimate. How can you do a best estimate? You can say it is a bit of a scenario analysis. Scenario analysis, what are the different possibilities? And on the basis of that, we may make some judgment. I may lose this particular case, right? In one case, the court has asked the party to pay 100% of the damages. In one case, the court has asked the party to pay, let us say, 50% of the damages. So I'm using these two past judgments, and on the basis of that, I will estimate that, okay, 100% and 50%. So somewhere in between, let me recognize 75%. And that is how I may recognize the provision. when those goods will be returned back because they have developed manufacturing defects. These manufacturing defects can be minor, these manufacturing defects can be major. If it is minor, how much I will have to incur as a cost? If it is a major, how much will I have to incur the cost? I am building different scenarios, and on the basis of that, I am projecting what are the possible outcomes, and finally I will be able to arrive at a reliable amount. An entity may determine a range of possible outcomes and can therefore make an estimate of the obligation that is sufficiently reliable. Okay. Provision should be measured before tax. Do not consider any tax effects over here. Tax effect is a subject matter of Ind AS 12. Ind AS 12 will take care of the tax. Don't incorporate the taxes over here. Provision will be recognized in your accounting books. That will become the carrying amount of the liability in your accounting books. That we will compare with the tax base. We will work out, is there any temporary difference, and if yes, what are the deferred taxes? All that is a matter of Ind AS 12. Provision should be measured before tax, as the tax consequences of the provision and changes in it are dealt with in Ind AS 12. Okay. At times, discounting may also be required to be done. My lawyers are advising that, see, this case will definitely run for another 3 years. You will be found liable. You know what my lawyers tell me is that, see, ultimately you will lose the case, but this case will definitely go on for another 3 years, and after 3 years you may have to pay so and so amount of damages. I will have to pay damages after 3 years, while provision is to be recognized as on today. Can I discount that amount and recognize the provision? Ind AS 37 says that where time value of money is material, you can discount the provision. Discounting technique can be used where effect of time value of money is material. If I am supposed to make a payment within 3 months, then no need to carry out any discounting. But if I have to make some payment after 5 years from now or 10 years from now, for example, I am selling my goods on a warranty of 7 years. 7 years. Even if after 6 years there is a problem, you can return the good to me. I will repair at my cost. Don't you feel time value of money is material over here? Because certain proportion of goods will be returned at the end of the first year, second year, third year, and so on. I will incur repair expenses after 6 years from now. Provision has to be recognized as on today. Time value is material over here. I should discount and recognize the provision. Okay. As we have already understood, the provision should be before a tax. If provision is before tax, then discount rate should also be before tax. It should be a pre-tax discount rate that reflect the current market assessment of the time value of money and risk specific to the liability. Okay, I should consider the risk which is associated with the liability, and I should also consider what is the market assessment of the time value of money, and on the basis of that I should select my discount rate. Getting it? So this is how the discount rate will be selected by me. For example, those repair expenses that I have to incur, there is a slight inflation risk over here. See, understand, today if the product is returned to me and I will have to incur a major expense, then I know 20,000 rupees, let's say I have to incur 20,000 rupees of expense, let's say. But if that same product is returned after 6 years and I have to incur a repair expense, then that repair expense after 6 years will not be 20,000. It would have increased. There is an inflation risk over here. You know, those expenses will be actually increasing. So all this risk and everything should be incorporated, and then I should decide what should be my discount rate. This is how a provision is going to be measured. This is how a reliable estimate of the provision will be made. And finally, before we wrap up this particular discussion, yes, the last note is what we will be discussing now. They are saying, yes, this particular note, it's a very interesting one. If any future action is available by which the obligation can be avoided, then a provision need not be recognized. What is an obligating event? We had seen the definition of obligating event. Obligating event is such an event that you are left with no realistic option, no realistic alternative other than settling that amount. Getting it? But if you have an option available, some action available in future by which you can avoid the obligation, then no need to recognize the provision. No need to recognize the provision. For example, let us say you are in the aviation sector. You are owning and operating, let us say, 3 aircrafts. Let's say 3 aircrafts. And there is a law, there is a legislation that after every 5 years, okay, after every 5 years, the aircrafts are required to be overhauled. Let's say you are in the aviation sector and the law says that after every 5 years, aircrafts are to be overhauled, right? Major inspection is required, major repairs have to be incurred. That is the law. Question is, am I supposed to recognize a provision for the overhauling expenses that I will have to incur? They are saying after every 5 years. Okay, think of a situation. 5 years are about to complete. Or you may even say the 5 years have already got completed. Am I supposed to recognize a provision for the overhauling expense? Think about it. Past event is that there is a law which requires overhauling and 5 years have got completed, or they are just about to get completed, right? Is there a present obligation over here? Outflow of resources, if I do overhauling, it is probable. Can I make a reliable estimate? Yes. Question is, do I have a present obligation? Now, if you see here, there is a future action available by which the obligation can be avoided. What is the future action available? Can you think of it? You are owning these 3 aircrafts which you are operating in your aviation business. These 3 aircrafts require overhauling. But do I have any action available by which I can avoid the overhauling? Tell me, can I avoid the overhauling? I can sell these 3 aircrafts and buy new 3 aircrafts. What do you say? Or let us say these aircrafts are on lease. Forget it. I'm not owning these aircrafts. These aircrafts are on lease. And you know, I purposefully enter into a lease contract for 5 years. I know after 5 years, the aircraft has to be overhauled. I enter into a lease contract exactly for 5 years. At the end of the 5th year, I will return back these aircrafts and I will procure new aircrafts on lease. Simple. My future action of substituting these old aircrafts with new ones, or substituting these old aircrafts with fresh overhauled aircrafts, means I can avoid the obligation. If any action is available by which the obligation can be avoided, then you will not recognize the provision. See, in earlier examples, there was no future action available. You may say that we will earlier example was that we were selling on warranty basis. You may say I will discontinue the system of selling on warranty basis. Now no warranty. No, I am not going to give you any warranty. Fine. But this will affect your new sales. What about the old sales which you have already done on warranty basis? You cannot escape from that, right? You have given them a warranty card. You are committed to repair those goods which are written for manufacturing defects. There is a pending lawsuit in the court. There is no realistic alternative available to you other than settling that obligation by chance if you lose that particular case. No future action is available by which you can avoid that particular obligation. You have sold on refund basis, right? You are telling your client that if you are dissatisfied, come within 7 days, I will refund it. You cannot now avoid this particular obligation. Yes, you may now discontinue your policy of providing a refund, but that, as I said, will affect your new sales, not the old sales where you have already promised it. So no realistic alternative was available other than settling the obligation. But when future action is available by which the obligation can be avoided, I shall not recognize a provision. Getting it? For example, let us say the government is introducing major changes in the Income Tax Act, major changes in corporate law, major changes in Ind AS, all of a sudden the government is in reform mode and major legislations in India are changed. Okay, because of this, I will have to provide training to my staff. Okay, I will have to now incur a staff training cost. Now, am I supposed to recognize a provision over here? I realize over a period of time that there are fresh people available in the market who are already having this knowledge. You know, there are a lot of refresher courses which are going on. Refresher courses which is updating the professionals about the new requirements. So what has happened is my employees are not having knowledge about the new requirements of the law, but fresh people are available in the market who are actually equipped with the latest understanding, equipped with the latest knowledge. I can ask my old employees to resign. Instead of asking, I will fire them actually, and I can recruit new employees. Do I have a future action available by which I can avoid the obligation? Answer is yes. And that is the reason I will not recognize a provision. Whenever future action is available by which a provision can be avoided, then I will avoid it, isn't it? And that is the reason provision need not be recognized. So finally, very quickly, keep this thing in mind. Yes, the three conditions for recognition of a provision. Understand? The questions that we will be given, they will ask us whether a provision is to be recognized or not, and we will have to answer that particular question. A provision will be recognized provided all the three conditions are getting satisfied. You must have a present obligation, and this obligation must be arising on account of a past obligating event. It should be probable, probability of more than 0.5, that there shall be an outflow of resources embodying economic benefits, and you should be in a position to reliably estimate the provision. If all the three conditions are getting satisfied, go ahead and recognize a provision. What if any of these conditions are not getting satisfied? If that is so, then you will not recognize a provision. Well, the next segment of Ind AS 37, it is dealing with contingent liabilities. Let us understand what do we mean by a contingent liability. Now, there are two possibilities of contingent liabilities. One possibility is where a contingent liability is representing a present obligation, or another possibility is that a contingent liability may be representing a possible obligation. Either it is a present obligation or it can be a possible obligation. Present obligation is something that we have already discussed in case of provisions, right? In the earlier segment, we have seen that the conditions to recognize the provision, the very first condition is that an entity has present obligation. In the conditions for recognition of provision, we are using present obligation words. And in contingent liability also, we are using the words present obligation. First and foremost, we should be very clear with the difference between provision and a contingent liability. Provision, present obligation word is there. Contingent liability also, present obligation word is there. What exactly is the difference then? Okay, I will take you back to the provision. If you want to recognize a provision, then all three below mentioned conditions need to be fulfilled. All three conditions are required to be fulfilled. Present obligation should be there. Outflow of resources should be probable. That is the chance, or we can say the probability should be greater than 0.5. And you should be able to reliably estimate the same. Just think for a moment. First condition is getting satisfied, but the second condition is not getting satisfied. What to do then? First condition is getting satisfied. There is a present obligation on account of a past event. That condition gets satisfied. But the second condition is that the outflow of resources embodying economic benefit should be probable. This condition is not getting satisfied. If the second condition does not get satisfied, you will not recognize provision. But understand, but it will become a contingent liability. Okay, it will become a contingent liability. You get my point? It's quite possible that second condition is not fulfilled. Even the third condition is also not getting fulfilled. Fine. First condition gets fulfilled. There is a present obligation, but I am not able to recognize a provision because outflow of resources embodying economic benefit is not probable. Okay, that's what we are referring over here now. Just see, a contingent liability. I am reading this portion. Please read along with me. A contingent liability is a present obligation that arises from past event but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Take the case of that pending lawsuit that we had discussed earlier when we were discussing the concept of provisions. There are certain clients of yours who are dissatisfied with the work that you have performed. They have taken you to court. Okay, present obligation is there because of a past event. But your lawyers are advising you that do not worry. There is a 60% chance that you will win this particular case. That means there is a 40% chance that I may lose. See, outflow of resources will be there only if I will lose this particular case, isn't it? What does that mean? The probability of outflow of resources is 0.5 or less. That means it is not probable. If it is not probable, I will not recognize a provision. Instead, I will show this as a contingent liability. I will treat this as a contingent liability. Then they are saying and oblique or the amount of the obligation cannot be measured with sufficient reliability. Understand, this is actually very rare. Under very rare circumstances, it will happen that you are not able to estimate the amount reliably. If I take you back to the conditions of provision, let me clear it up so that I can again explain you the whole thing. What we are saying is that the entity has a present obligation because of a past event. This condition gets fulfilled. Outflow of resources is also probable. This condition is also getting fulfilled. But the third condition does not get fulfilled. If I want to recognize a provision, all the three conditions need to be fulfilled. But the third condition is not getting fulfilled here. And that is the reason I will not recognize a provision. It will again become a contingent liability. But what I am trying to say is that the first and the second condition is getting fulfilled, but the third condition is not getting fulfilled. This is something which is very rare. Under very rare circumstances, this is possible. You only think of it. You have a pending lawsuit, present obligation, past event getting fulfilled. Your lawyers are saying, be prepared. 80% chance that you will lose this particular case. There is a probable outflow of resources this time. Second condition also getting fulfilled. So I asked my lawyers, how much will I have to pay? The lawyers are saying that we do not know. That we do not know. Now, why are the lawyers not knowing that how much amount will we pay? One possibility is that this particular case law is relating to some new legislation. Let us say the government has brought some new legislation and this is the very first legal suit with respect to that legislation. We do not have any set precedents, and that is the reason we are not aware what will be the amount of damages that you may have to ultimately pay. So that might be a reason that we are not able to accurately or reliably measure the same. Or another possibility is different high courts have interpreted this matter differently. Some high court is saying that, okay, this is to be done. Some high court are disagreeing. They are saying that, no, this is how it is to be done. There is no clarity at all. In such kinds of situations, which is very rare, but it's possible that the third condition for recognizing the provision is not getting fulfilled. In such a situation also, it will become a contingent liability. Getting my point? So what we are trying to say is try to understand this with reference to the provision. If all three conditions are getting fulfilled, it is a provision. But any of the condition is not getting fulfilled. First condition is getting fulfilled, of course, because there has to be a present obligation. But the second and the third condition, both are not getting fulfilled, or any one of them is not getting fulfilled. I cannot recognize a provision, but it shall become a contingent liability. That is a case of a contingent liability assuming the form of a present obligation. Contingent liability can also be a possible obligation. Possible obligation means it may arise in future, it may not arise in future. You can even have such kinds of contingent liabilities. For example, let us say you are selling on credit basis. Okay, you sell on credit basis, that is giving rise to certain bills receivables, and it is my policy to get the bills discounted with the bank. Okay, I sell to you on credit basis goods worth rupees 5 lakhs. You are supposed to pay me after 3 months, but I need the money right now. I take this bill of 5 lakhs to the bank, I discount it with the bank. After 3 months, the bank will present this bill to you. If you honor the bill to the bank, then no problem. But if you dishonor the bill, then that bill will be returned back to me by the bank. And now I will have to make good the loss to the bank, isn't it? In other words, I may be liable, I may not be liable. If you are making the payment to the bank, I will not be found liable. And if you dishonor the bill, then I will become liable. This is what we are saying is a possible obligation. A contingent liability is a possible obligation. I am reading this particular portion, yes, that arises from past events and whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. I sold goods to you on credit basis. I discounted the bill will be presented to you by the bank, right? You will make the payment to the bank or not make the payment to the bank is an event which is not within the control of my entity. You get it? They are saying one or more uncertain future events not wholly within the control of the entity. Yes, the best thing that I can do is I can just send you a reminder. I may just tell you, just before the due date, I may send a reminder to you that see, after 2 or 3 days of that SBI or the bank with whom I have discounted, they will present the bill. Please make the payment to them. This is the maximum that I can do. I can't force you to make that payment. This is an uncertain future event. It is not wholly within my control. And if you dishonor the bill, I will be found liable. This is nothing but a contingent liability. We may even include over here bank guarantees as well. Right, that thought will definitely come to your mind. Let us say one company is taking a loan and you are providing a guarantee. You are telling the bank that, see, if this party does not make the regular payments, I will pay on behalf of this particular person. As long as that other party is making the payments, I will not be found liable. The moment the other party will start making the payments, then I will be found liable. This is also a very good example, right? This financial guarantee contracts or bank guarantee contracts are very good examples of contingent liabilities, but they are outside the scope of Ind AS 37. I'll take you back to the scope of Ind AS 37. This is the scope of Ind AS 37, which we have discussed earlier, right? They are saying that Ind AS 37 should be applied by all entities and accounting for provision, contingent liabilities, contingent assets, except, and now if you look into this part B, they say financial instruments, and then they say including guarantees, which are within the scope of Ind AS 109. Getting it? It's a good example of contingent liability, agreed. If you are asking me what is an example of contingent liability, it's a very good example. Someone has taken a loan, you have provided a financial guarantee to that particular loan. That person does not make the payment, you will be found liable. If you ask me, give me an example of contingent liability, it is definitely a contingent liability. Only thing is, Ind AS 37 is not applicable to it. It is outside the scope of Ind AS 37. But instead of that, what if you have given a performance guarantee? Let's say a performance guarantee. You are providing a guarantee to the other party that, see, you buy from this particular person, this person will supply you 1,000 units. But by chance that person is not able to fulfill the requirement of 1,000 units, then whatever is the balance, I will provide those units. You get my point? So you are providing something like a performance guarantee. In such kind of a situation, yes, it may be turning out to be a contingent liability if the other party defaults, and it is something that will be covered by Ind AS 37. One more thing, yes, many a times what happens is that you might be providing certain guarantees to government departments. You know, for example, when you are exporting goods, you will provide guarantee to the customs department that, see, the goods that I am exporting are legal. The classification of the goods which is required, I have done it properly. If there is some import duty payable, I've already made those payments. You are providing certain guarantees to the custom department. Later on, the custom department discovers that certain information given by you was incorrect, and hence it is levying a penalty to you, right? Question is this a contingent liability? Because a possible obligation may arise over here. The penalty that you may have to pay, you may consider that to be a possible obligation. This is not an example of contingent liability. The guarantees that you are providing to the customs department are not turning out to be a contingent liability. Why is it so? For something to become a contingent liability, it should be something which is not wholly within the control of the entity. You get it? When you are providing the information to the customs department, that information is absolutely within your control. I hope you are getting my point. If you are hiding something from the customs department, you know that very well, isn't it? If you have done a wrong classification of the goods, you know it very well. You are doing it purposefully so that you can save as much of tax as possible. It's quite possible, right? And that is the reason. This information is within the control. You cannot argue that later on I may be found liable for the penalty payable and hence it's a contingent liability. No, it is not turning out to be a contingent liability. But yes, if there are certain disputes that you are having with the customs department and you are arguing that no, I am correct, then you may classify that as contingent liabilities, but they will not be possible obligations. They will become present obligations, right? You may have a dispute with the GST department. You may have a dispute with the income tax department. You may have a dispute with any government department, right? But what you are doing is you are not agreeing to any of them. There are certain deductions that you have claimed which have been disallowed by the assessing officer. You have approached the appellate tribunal. You are not ready to acknowledge that you have done anything wrong. We will consider this as a present obligation because the case is already lying with the appellate tribunal. But you are of the view that you will win this particular case and hence you are disputing the treatment which has been given by the income tax department. This is nothing but a contingent liability for us, but it is out of present obligation, not out of possible obligation. So if there are contingent liabilities and these contingent liabilities are covered by Ind AS 37, then what is the further requirement of the Ind AS? Ind AS 37 says that you will not recognize contingent liability, only disclosure of contingent liability will be given. However, if you are of the view that the probability of outflow of resources is remote, then no need to even provide a disclosure. Okay. An entity should not recognize a contingent liability. Do not recognize a contingent liability in your books. In footnotes, you are supposed to provide the disclosure. Contingent liability should be disclosed unless possibility of outflow of resources embodying economic benefits is remote, right? That same example of bills discounting. We say that the bills have been discounted and these bills will be presented to our client. We have been doing this since last many years. Every time our client has honored the bills. I have no reason to believe that the bill will be dishonored, and that is the reason I feel that the possibility of outflow of resources is remote. Although there is a contingent liability, I will not disclose it because possibility of outflow of resources is remote. If it is not remote, provide a disclosure for the same. For example, that pending lawsuit, right? 40% chance is there that you may lose the case. Okay, I will show it as a contingent liability. Over here it will be disclosed because there is a 40% chance that I may still have to make a payment. I cannot say that the payment is the possibility of payment is remote. I need to provide a disclosure for the same. Yes, an interesting point here. They are saying where an entity is jointly and severally liable for an obligation, the part of the obligation that is expected to be met by other parties should be treated as a contingent liability. Let us say you and 9 other companies, there is a cluster of 10 companies, let's say, and you are all producing similar kind of hazardous chemicals, and there is a nearby flowing river. You and the rest of the 9, every one of you is releasing pollutants in that river. The government department discovers this, serves a notice to you and the others, and asks you to clean up that river. The cost of cleaning up the river will turn out to be 10 lakhs, and you have all decided to share it equally. You are 10 units, and 1 lakh rupees is the total cost. Each one of you will have to bear 10,000 rupees of expense. 10,000 that you have to bear is a provision. And what is to be met by others, which is 90,000 rupees, that will be understood as a contingent liability. You can see here where an entity is jointly and severally liable. You and 9 other units, total 10 units, right? You have been polluting the river. Getting it? And now you have been served a notice. Not only you, the other units are also served a notice that please clean up the river. For cleaning up the river, the 10 units are jointly and severally liable. Okay. If you will not clean up the river, the notice is very clear. A timeline has been given. And after that also you are not cleaning up the river. The government has made it very clear that all 10 units will be sealed. Okay. The 10 of you have a meeting. You decide to incur the expense, which you have estimated to be around 1 lakh of rupees. Each one of you will contribute 10,000 rupees. That's what I'm saying. 10,000 rupees that you will contribute will give rise to a provision, while 90,000 rupees, which is going to be borne by the others, that should be treated as a contingent liability. Why? Because if any of them do not make the payment, the others will have to step in. Getting it? In these kinds of situations, it's always possible that some party may argue that I am polluting less and you are polluting more. Understand? Total 10 units are there. So some company which is relatively smaller, let us say, may argue that I am polluting less. Why should I contribute 10,000? I'll contribute less. I will contribute only 3,000 rupees. I'll contribute only 4,000 rupees. The rest of the companies will then have to step in. Because if you will not clean up the river, if you do not clean up the river, your unit can be sealed. You will not be allowed to do the business over there anymore. And that is the reason, if another party does not make the payment, you will be found liable for the same. It's a possible obligation. You should treat it as a contingent liability. And finally, yes, contingent liabilities are assessed continually to determine whether an outflow of resources embodying economic benefit has become probable. Your lawyers are advising you, do not worry. Our chance of winning is 60%. Your chance of losing is 40%. Right? I am classifying this as contingent liability. And accordingly, I am providing a disclosure in my books. Getting it? This is what has happened on 31st March 2021. Okay. On 31st March 2022, my same lawyers, my same lawyers are saying that the chance of winning now is 30% and the chance of losing now is 60%. My lawyers are advising me that, see, there have been new developments now. Some new evidence which was not available earlier has now been submitted by the aggrieved party. And because of this reason, the tables have turned. Lawyers are saying that now there is a 60%, instead of 60, it should not be 60. Now there is a 70% chance that you will lose this particular case. Earlier, I classified this as contingent liabilities, but contingent liabilities have to be continually assessed and reassessed. As you can see, now the probability of outflow of resources is greater than 0.5. Now it is no longer a contingent liability. I need to recognize a provision for the same. If outflow of future economic benefits becomes probable, then a provision should be recognized. Now I'll have to recognize a provision over here. It is no longer fulfilling the definition of a contingent liability. Measure the amount of provision to be recognized in the following cases. An entity sells goods with a warranty under which customers are covered for cost of repairs of any manufacturing defects that become apparent within the first 6 months after the purchase. If minor defects were detected in all the products sold, repair costs of rupees 1 million would result. If major defects were detected in all products sold, repair costs of 4 million would result. The entity's past experience and future expectations indicate that 75% of the goods sold will have no defects, 20% of the goods sold will have minor defects, and 5% of the goods sold will have major defects. In accordance with the standard, an entity assesses the probability of an outflow of the warranty obligations as a whole. You are selling your products under a warranty that within 6 months from the date of sale, if they are developing any manufacturing defects and the customers can return those products to us, we will repair those products at our cost, and then the repaired product will be again sent back to the customer. Now towards the end, they are saying that we are of the view that out of all the products that we have sold, 75% will have no defects at all. In other words, for 75% of the goods sold, I do not have to recognize any provision for the expected warranty cost or for the expected repair cost. 20% will have minor defects. Okay, 20%. And if there are minor defects, then the cost is going to be 1 million. And 5% will develop major defects. If there are major defects, then I'll have to incur 4 million. Recognizing the provision or the amount of provision is as simple as this. 75% I do not have to incur any expense at all. So 75% should be multiplied by nil. 20% will develop minor defects for which I will incur 1 million. So 1 million should be multiplied by 20%. And 5% will develop major defects for which the cost will be 4 million. So 4 million should be multiplied by 5%. That's what we have done here. 75% of nil, 20% of 1 million, 5% of 4 million. The final answer is turning out to be rupees 4 lakhs. You should recognize a provision for 4 lakhs. X Solar Power Limited, a power company, has present obligation to dismantle its plant after 35 years of useful life. X Solar Power Limited cannot cancel this obligation or transfer it to a third party. X Solar Power Limited has estimated that the total cost of dismantling at 50 lakhs, the present value of which is rupees 30 lakhs. Based on the facts and circumstances, X Solar Power Limited considers the risk factor of 5%. That is the risk that the actual outflows would be more than the expected present value. How should X Solar Power account for the obligation? We are basically measuring the obligation of dismantling the plant 35 years from now. You have started the solar power plant right now. It seems to be having a useful economic life of 35 years. And at the end of 35 years, you'll have to dismantle it. The total cost is turning out to be 50 lakhs. But if you are incurring an expense after 35 years, then time value of money definitely is becoming material. And hence we have discounted it. And after discounting it, the present value is turning out to be 30 lakhs. But you feel that although you have done projections, but there is still a 5% risk. 30 lakhs, I should increase it by 5%. That's the best thing that I can really do. I will take 30 lakhs of rupees and multiply that by 1.05. We should just increase it by 5%, which is turning out to be 31,50,000. We should recognize a provision for 31,50,000. The obligation should be measured at the present value of the outflows, 30 lakhs, risk adjustment of 5%, 1,50,000. You add the two, you get 31,50,000. ABC Limited has an obligation to restore the seabed for the damage it has caused in the past. It has to pay rupees 10 lakhs cash on 31st March 2023 relating to this liability. ABC Limited's management considers that 5% is an appropriate discount rate. The time value of money is considered to be material. When they say time value of money is material, that means we have to adopt the technique of discounting. Calculate the amount to be provided for at 31st March 2021 for the cost of restoring the seabed. You have to recognize a provision on 31st March 2021 while the expense is going to be incurred on 31st March 2023, that is 2 years from now, and your discount rate is 5%, you should calculate the second year present value factor at 5%, and 10 lakhs should be multiplied by that. That will give you the present value. That is what should be provided. Discounting factor of 5% for second year as on 31st March 2021 is 0.907. 10 lakhs I am multiplying by 0.907. I am getting 9,07,000. That's your amount of proof. Assume that the firm has not been operating its warranty for 5 years and reliable data exists to suggest the following. If minor defects occur on all products sold, repair cost will be 20 lakhs. Major defects are detected in all products, it will be 50 lakhs. The manufacturer's past experience and future expectations indicate that each year 80% of the goods sold will have no defects, 15% will have minor defects, 5% will have major defects. Calculate the expected value of the cost of repairs in accordance with the requirements of Ind AS 37. If any, ignore both income tax and the effect of discounting. Fair enough. This is very much like one of the earlier cases that we had done. 20 lakhs is for minor defects, and the probability for minor defect, the percentage of goods which may have minor defects is 15%. Hence 20 lakhs should be multiplied by 15%. Major defects will be 50 lakhs. 5% of the total products that we have sold will be developing. We are expecting that it will develop a major defect. So 50 lakhs should be multiplied by 5%. And 80% should be multiplied by 0, right? 80% into nil, 15% into 20 lakhs, 5% into 50 lakhs. Answer is turning out to be 5,50,000. 5,50,000 is the provision that needs to be recognized over here. On 1st April 2017, A Limited assumes a decommissioning liability in a business combination. The entity is legally required to dismantle and remove an offshore oil platform at the end of its useful life, which is estimated to be 10 years. A Limited uses the expected present value technique to measure the fair value of the decommissioning liability. Present value technique, that means this will involve discounting. If A Limited was contractually allowed to transfer its decommissioning liability to a market participant, it concludes that the market participant would use the following inputs. Probability weighted as appropriate. When estimated the price it would expect to receive. We are assuming some decommissioning liability. This is an expense which is to be incurred 10 years from now. We are supposed to find out what is the amount of provision for decommissioning liability to be recognized. Okay. And because the cost is to be incurred 10 years from now, we are considering time value of money to be material. That is the reason they are saying that we will use expected present value technique. Now what they are arguing is that if we transfer the decommissioning liability to a third party, how will the third party determine what will be the total amount of the decommissioning liability? What I am doing is I am outsourcing this job to you. I am asking you that why don't you remove this offshore oil platform and tell me how much will you charge for it. Okay, your charge for me will become the cost, and I will find out its present value, and that will be the amount of the provision. Okay, certain estimates are now given to us and we shall be using the same. They are saying labor costs are developed on the basis of current marketplace wages adjusted for expectations of future wage increases, required to hire contractors to dismantle and remove the offshore oil platforms. A Limited assigns probability assessments based on A Limited's experience with fulfilling obligations of this type and its knowledge of the market to a range of cash flow estimate as follows. Right, what we have done is we have tried to develop a certain ranges of labor expenses. The labor expense may turn out to be 50,000 with a 25% probability, 62,500 with a 50% probability, and 87,500 with a 25% probability. It seems that we have made 3 projections of our expected labor costs. Obviously, we cannot do calculations with 3 figures. Since probabilities are given, it makes sense that we multiply them with their probabilities and take a total and find out what is it on expected basis. What we are doing is we are calculating what shall be the expected labor costs. The expected labor cost will be 50,000 multiplied by its probability plus 62,500 with its probability plus 87,500 with its probability, right? This is the calculation that we will do for our expected labor expenses. 50,000 into 0.25, 62,500 into 0.5, and 87,500 into 0.25. Yes, it is turning out to be rupees 65,625. We are expecting the labor expenses to be 65,625. Okay, let's move further. In information 2, they are saying A Limited estimates the allocated overhead and equipment operating cost to be 80% of the expected labor cost and consistent with the cost structure of the market. Okay, we are expecting overheads to be 80% of expected labor cost. That means 80% of 65,625. I take its 80%, that is turning out to be 52,500. Okay, I am getting 52,500 over here. So we have 65,625 and 52,500. Let me take a total of the two. For the moment, I am getting 1,18,125 as the expense. Yes. What more are they saying now? A Limited estimates the compensation that a market participant would require for undertaking the activity and for assuming the risk associated with the obligation to dismantle and remove the asset as follows. A third-party contractor typically adds 20% markup on labor and allocated internal costs to provide a profit margin on the job. They are saying 20% markup on labor and allocated internal costs. The labor cost we had determined earlier, 65,625. Then the internal cost or the overheads are 52,500. The total turns out to be 1,18,125. They are saying a typical contractor will require 20% markup. This 1,18,125 I'm multiplying by 20%, right? 20% is the profit element over here. I multiply this by 20%. It is turning out to be 23,625. Getting it? What I should do now is I should take 1,18,125 and to this I should add up the markup, which is 23,625. As I add up the two, I get 1,41,750. Okay, this will be perhaps the quoted price, 141,750. What we have done is we are simply arguing in this way that if we outsource this work to a third party, how much will the third party charge? Then we are projecting that what will be the labor cost. We realize it is 65,625. Apart from that, there shall be other overhead costs, which is turning out to be 80% of the labor cost. So I get 1,18,125. But this is only cost. A person who will do this job obviously will also like to have some reasonable profit. Our calculations are showing that 20% markup is what is normally charged. And hence what I have done is I have taken 1,81,125 and added 20% to it, which is giving me 1,41,750. Okay. Then they say A Limited estimates 5% premium of the expected cash flows, including the effect of inflation, for uncertainty inherent in today's price for a project that will not occur for 10 years. They are saying that, see, whatever projections you are doing, there is a 5% risk. 5% risk means it may eventually turn out to be 5% more than what you had projected. Now, I have projected 141,750, but they are saying 5% premium should be including the effect of inflation. Now, we have not given any effect of inflation right now. Hence, this information of 5% will have to wait. I can give the effect of 5% only if my cash flows are including the effect of inflation. Right now, I have not considered any effect of inflation. Hence, I am waiting for this 5% premium adjustment. In 4, they are saying entity A assumes, yes, I got it now. Assume the rate of inflation of 4% for the 10-year period on the basis of available market data. They are saying that if today you are outsourcing this job, then the typical third-party contractor will charge 1,41,750. But you have to incur this expense after 10 years, and during this 10 years, the cost will escalate at the inflation rate of 4%. To this 141,750, I should now apply the inflation factor. Okay. What we have now is we have 1,41,750. This we should now multiply by inflation factor. Okay, we should multiply with the inflation factor. We are expecting the inflation to be 4%. I should take 1.04 and raise it to 10. Every year the cost will increase by 4%, 4%, 4%. Technically, we can say the cost is getting compounded at 4% for 10 years. How can I find out the amount compounded at 4% for 10 years? Here it is. You may say it is inflation factor, or you may even say it is the compound value factor. Okay. I take 1.04 and multiply that by 10 times. 2, 3, 4, 5, 6, 7, 8, 9, and 10. Yes. I am getting the inflation factor to be 1.4802. Okay, 1.4802. Okay, 1.4802. I multiply by 1,141,750. I multiply by 1.4802. I am getting now 2,09,818. Yes. 2,09,818. After including the effect of inflation, it is turning out to be 2,09,818. And now you know what I'll do? I will give effect of this. They say A Limited estimates 5% premium of the expected cash flows, including the effect of inflation. I have already given the effect of inflation now. Including the effect of inflation, the final cash flows expected at the end of the 10th year is 2,09,818. But there is a 5% risk. 5% risk means although you have done all the projections, there is a possibility that the ultimate cash flow may turn out to be 5% higher than what you have projected. Okay, then to this 2,09,818, do one final adjustment. Increase it by 5%. Okay, increase it by 5%. So what shall that be? Okay, what I do now is, just a second. I take 2,09,818 and I increase it by 5%. This is giving me 220,309 or maybe 308. Okay. This is what I am getting. I am giving effect of the adjustment for 5% premium because they are saying that it may increase by 5%. 5% risk is there. Finally, I am getting the amount that I am expected to spend after 10 years. After 10 years, the cost will be 2,20,309. You are expected to incur an expense of 223,09 after 10 years. But provision for the decommissioning liability is not to be recognized after 10 years. It is to be recognized as on today. Needless to say, you know it very well what will be now required to be done. 223,09, which I'm expecting to incur after 10 years, needs to be discounted and brought to its present value as on today. For this, I require the discount rate and the present value factor. Okay. The final point 5. The risk-free rate of interest for a 10-year maturity on 1st April 2017 is 5%. A Limited adjusts that rate by 3.5% to reflect its risk of non-performance. That is the risk that it will not fulfill the obligation, including its credit risk. They are saying risk-free rate is 5%. They seem to be looking at some 10-year bond, and the 10-year bond is providing a risk-free rate of 5%. Hence, we are starting with 5%. And to 5%, we are adjusting 3.5. 3.5? They are saying there is a risk of non-performance. What if after 10 years, I don't have the necessary cash and I cannot incur this expense at all? Isn't it? It's quite possible your business may fail and you may not have the necessary funds. 3.5% they are saying is the risk of non-performance. Great. I should now take 5 plus 3.5. 5 is the base rate that I have decided, and 2 that I will add the risk premium for 3.5. That gives me 8.5%. My discount rate will be 8.5%. They've already given that 8.5%. Present value factor 0.4423. Please multiply this by 0.4423. Okay, into 0.4423. I am getting approximately, yes, I am getting 97,443, approx 97,443. This is the amount of provision that needs to be recognized for the decommissioning liability as on today. Hope you are comfortable with the workings on the figures. A Limited concludes that its assumptions would be used by the market participant. In addition, A does not adjust its fair value measurement for the existence of a restriction preventing it from transferring its liability. Okay, measure the fair value of the decommissioning liability. We are through with it. 97,443. Here it is. Right, all calculated and given. 97,443. That's the last figure that I really remember. Okay, and that's how the whole thing really started. It started with this working note. We first calculated the expected labor cost, 65,625. Right, we have done that in our answer. Here it is. 65,625, isn't it? 65,625. And then what we did is we went for the labor costs, 80% of that, 52,500, then 20% markup, and that's how we got the base figure, 141,750. This we had to increase by inflation to get 209,000. Then we added 5% premium for the risk that it might be higher by 5%. We got 223,09, and those 223,09 we have discounted at the 10th year present value factor at 5 plus 3.5, which is 8.5%. That's how we are getting 97,443. Marico has an obligation to restore environmental damage in the area surrounding its factory. Expert advice indicates that the restoration will be carried out in 2 distinct phases. The first phase requiring an expenditure of rupees 2 million to remove the contaminated soil from the area, and the second phase commencing 3 years later from the end of the first phase to replant the area with suitable trees and vegetation. The estimated cost of replanting is rupees 3.5 million. Marico uses a cost of capital before taxation of 10%, and the expenditure when incurred will attract tax relief at the company's marginal tax rate of 30%. Marico has not recognized any provision for such costs in the past, and today's date is 31st March 2022. The first phase of the cleanup will commence in a few months' time and will be completed on 31st March 2023, when the first payment of rupees 2 million will be made. Phase 2 costs will be paid 3 years later from the end of the first phase. Calculate the amount to be provided on 31st March 2022 for the restoration costs. You are having an obligation of restoring the environmental damage caused by your factory in the surrounding areas, right? And they are saying that 2 phases will be conducted for the restoration. The first phase is just about to begin within a few months, and by 31st March 2023, it will get completed. Now, since you are recognizing the provision on 31st March 2022, incurring a cost of 2 million on 31st March 2023 means 1 year from now. Okay. And then for the second phase, they are saying that second phase will commence 3 years later from the end of the first phase. First phase will end 1 year from now, and then another 3 years. That means if you see from today, the second phase will start 4 years from now. Hope you are okay with that. First phase will get completed on 31st March 2023, and today is 31st March 2022. That means the first phase will get completed after 1 year from now. And then if you see what I have highlighted, second phase is commencing 3 years later from the end of the first phase. 3 years from the end of the first phase, but first phase will end 1 year from now. Then 3 years from 1 year. That means when you see it from today, it is turning out to be 4 years time. That means these cash flows are going to be incurred, or these cash flows will occur at the end of the first year from now and at the end of the fourth year from now. You require the relevant discount rate, and we require present value factor for the first year and present value factor for the fourth year. We carry out the discounting, we will get the amount of the provision. Then they have given some tax rate also. They are saying that Marico is using a cost of capital of 10%. It is before tax. So 10% is the discount rate. And these expenditures will be attracting 30% tax. Should I consider the expenditures net of tax? Should I consider the discount rate net of tax? You have to always consider the discount rate as well as the expenses as well as the cash flows before tax. Ind AS 37 deals with provision and Ind AS 12 deals with income taxes. Let us not mix up the two Ind AS. What are the tax benefits? What will be its provision? What will be its tax base? All these are issues of Ind AS 12. Let Ind AS 12 tackle that. Do not bring taxation into account when you are providing for the provision. Ignore the taxes. Okay, just ignore the tax rate as if the tax rate is not printed at all. Right? Just ignore it in that way. Okay. That will make things really simpler now, I believe. Right? As we have already understood, you will be having cash outflows at the end of year 1 and at the end of year 4. I will take the cash outflows. Right, first one is going to cost me 2 million, or you can say 20 lakhs. And the second phase will cost you 3.5 million, or you can say 35 lakhs. And then you take present value factors at 10% and work out the present value. First year present value factor is 0.909. Fourth one, I believe, is 0.6832. Yes, it is 0.683. Take 20 lakhs, multiply that by 0.909, isn't it? I am getting 18 lakhs, 18,000, and 35 lakhs into 0.683, that is giving me 23 lakhs, 90,500. Please take a total of the two. It is turning out to be 42 lakhs, 8,500. This is the amount of provision that needs to be recognized as on today. Here it is, 42 lakhs 8,500. Provision will be calculated using the pre-tax cost and the pre-tax cost of capital, right? All those things will be deductible temporary difference, and then hence it will be a matter of Ind AS 12. Just discount the cash flows and work out what will be the present value. That's the end of the answer. Let us deal with the final part of the title of Ind AS 37. We know the title of Ind AS 37 is Provisions, Contingent Liabilities and Contingent Assets. We have already dealt with provisions and contingent liabilities. Now it is time for us to understand what do we really mean by contingent asset And what shall be the treatment of contingent assets when we are preparing our financial statements? Let us take that same example that we have been taking up even earlier. There is a case which has been filed against the company. Let us say there are some aggrieved parties who have taken you to court. Your lawyers are advising you that you may lose this particular case and so amount of damages are required to be paid. This becomes a classical case of where a provision should be recognized. I have a past event. There is an aggrieved party who has taken me to court. So there is a pending lawsuit. That's the past event. Present obligation is there. The lawyers are advising you that you will most probably lose this particular case. Hence, it is probable that there shall be an outflow of resources. By word probable, we mean more likely than unlikely, probability greater than 0.5. And you are in a position to estimate the amount of the obligation reliably. Hence, you are recognizing a provision. In case if your lawyers are saying that do not worry, there is only a 20 to 30% chance that you will lose this particular case. Outflow of resources this time is not probable. And that is the reason we will not recognize a provision. Instead, we will show it as a contingent liability. But then why always something bad will happen with the company? Why is it that the cases are filed against us? Why is it that it's always us to whom the lawyers are advising that you may lose the case? What if it is the other way around? What if it is you have taken some another party to the court? Let us say there is some competitor of yours who has copied your design, who has copied your patent. For infringement of patent, you are filing a case and your case is really strong. Your lawyers are advising you that see, 80% chances there that we will win this particular case and we will get damages from the other party. This is what is going to give rise to a contingent asset. I hope you are getting my point, right? In provisions and contingent liabilities, we were always talking about outflow of resources embodying economic benefits. But what if there shall be an inflow of resources, but the inflow of resources is not confirmed? Understand, if the inflow of resources is 100% sure, then it is not a contingent asset. You may get the inflow of resources, you may not get the inflow of resources. Whether you will get it or not, it will be confirmed in future. It will be confirmed in future by occurrence or non-occurrence of an uncertain event or events which are not wholly within your control. This is what is going to give rise to a contingent asset. Let's see the definition for the contingent asset. We say a contingent asset is a possible asset. Try to think about contingent liability. We were saying that contingent liability is a possible obligation. It can be a present obligation also for which a provision is not recognized, or the other part of the contingent liability definition. Here it is, the other part of the contingent liability definition. I'm referring over here. They say a contingent liability is a possible obligation. Here in contingent asset, we say it is a possible asset. If you will compare the definition of contingent liability and contingent asset, you will realize, except for the word obligation there and the word asset over here, the rest of the definition is the same. They are saying a contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. They say an example is a claim that an entity is pursuing through legal processes where the outcome is uncertain. As I said, you have filed a case against one of your competitors for infringement of patent, and your lawyers are advising you that there is a very high chance that you will win this particular case. Hence, through legal processes, there is a possibility that there shall be an inflow of resources. This inflow of resources, that is what we are referring as a possible asset. But you are not 100% sure. And because you cannot 100% sure, you cannot recognize a contingent asset in financial statements. Understand that. When your lawyers tell you that there is an 80% chance that you will win this particular case and you will get a damages of minimum 1 lakh rupees, I cannot credit 1 lakh to my P&L. 80% chance is only there. It's not 100% sure. Okay, that is the reason we are not going to creditor or P&L, contingent assets will not be recognized in the profit and loss account. The reason being that by chance if the contingent asset does not get realized, you will end up recognizing an income which perhaps will be never realized. In order to avoid such a thing, we are not going to recognize contingent assets in our books. But hey, contingent assets can definitely be disclosed in our notes. You can disclose in the notes if the possibility of inflow of resources is probable. By the word probable, we mean it should be having a probability of greater than 0.5. Think in this way. You have filed a case against your competitor, your lawyers are advising you, you have a strong case, you will win this particular case, you will receive a damages of, let us say, 10 lakhs. Your lawyers are saying that there is a 70% chance that you will get damages. 70% chance, that means the inflow of resources is probable. You should disclose this contingent asset. Okay, but if your lawyers are saying you that there is a 30% chance that there shall be an inflow of resources, that means inflow of resources is not probable. By probable, I mean probability should be greater than 0.5. If the probability is greater than 0.5, provide a disclosure. If the probability is 0.5 or less, do not provide a disclosure. So that is dealing with the treatment of the contingent assets. Contingent assets are not recognized in financial statements, since this may result into recognition of income that may never be realized, isn't it? A contingent asset should be disclosed where an inflow of economic benefits is probable. Understand, probable means probability of greater than 0.5. However, when the realization of income is virtually certain, then the related asset is not a contingent asset and its recognition is appropriate. When your lawyers say 100% chance that you will win this case, or let us say the judgment is out, the court has provided its judgment and now it is confirmed that you are going to receive the money. Now this is no longer a contingent asset. Now recognizing income out of it is appropriate. And finally, contingent assets, and this was there in contingent liabilities also. Contingent assets are assessed continually to ensure the developments are appropriately reflected in the financial statements, right? Your lawyers are saying 80% chance that you will win this particular case. I'm providing a disclosure with respect to it. And finally, the verdict is out. Now there is 100%, right? The inflow of resources is now confirmed. It is 100% that you will receive this money. This is now no longer a contingent asset. The asset and the related income should be now recognized in the profit and loss. But when? It will be recognized in the P&L of the period in which such change occurs. If it has become virtually certain that an inflow of economic benefits will arise, the asset and the related income are recognized in the financial statements of the period in which the change occurs. Getting it? Of course, we keep on using the term virtually certain. By virtually certain, theoretically, by virtually certain, we mean you should be 100% sure. Although practically many times there are companies which say that if we are 90% or more sure, it's as good as virtually certain. There are certain companies which suggest that if we are 95% or more sure, we do consider it to be virtually certain. No definition is provided for virtually certain, hence it is left to the judgment of the management. Theoretically, virtually certain should be understood as 100% sure, although practically 90% or more sure, 95% or more sure can also be considered to be as good as virtually certain. So that's what you will be doing with respect to the contingent assets, right? Unlike a contingent liability, a contingent asset will not be always disclosed. Contingent assets will be disclosed provided the inflow of economic benefits is probable. Again, remember, by probable we mean that the inflow of resources is carrying a probability greater than 0.5, or in percentage we can say that there is more than 50% chance that there shall be an inflow of resources. Then go ahead and disclose the contingent assets in your notes. Just as you disclose contingent liabilities, you should also disclose contingent assets. respond to the following cases. Let's start with the first one. A company manufacturing and supplying process control equipment is entitled to duty drawback if it exceeds its turnover above a specified limit. To claim the duty drawback, the company needs to file the application within 15 days of meeting the specified turnover. If application is not filed within the stipulated time, the department has discretionary power of giving the duty drawback credit. You are manufacturing certain process control equipments, you are entitled to duty drawback provided your turnover is crossing a specified limit, and also if you are filing the application for the duty drawback within 15 days of meeting the specified turnover. What if you do not file within 15 days? You can still get the duty drawback, but then it will be at the discretion of the department. Further in the case, they are saying that for the year 2021-22, the company has exceeded the specified limit of turnover by the end of the reporting period, but the application for duty drawback is filed on 20th April 2022, which is after the stipulated time of 15 days of meeting the turnover condition. The year has come to an end. You have already surpassed the specified limit of the turnover, but you were supposed to file for duty drawback within 15 days. You are filing on 20th April. That means that window which was given of 15 days, you have breached that window. Duty drawback, then they are saying in the second last para, duty drawback has been credited by the department on 20th June 2022 and financial statements have been approved by the board of directors of the company on July 26, 22. Whether the duty drawback credit should be treated as an adjusting event. Okay. Whether we can recognize the duty drawback in our books, that can also be yet another way in which the question can be put. See, what has happened is the year has come to an end. You have already crossed the specified limit of the turnover, but you did not file the application within 15 days. That means now the department has discretionary power whether to give you credit or not. Later on, they are saying that duty drawback was credited by the department. Okay, on 20th June, we got the credit of the duty drawback from the department, and our financial statements are approved in July. Okay, year got completed on 31st March. On 20th April, you filed for the duty drawback. On 20th June, you got the credit. On 20th June, when you got the credit, the financial statements were still not approved. Hence, they are asking us the question, can we treat the duty drawback as an adjusting event? Or in general, we can say, what shall be the treatment of the duty drawback credit over here? As on 31st March, when you were finalizing your financial statements, as we know, we had not filed for the duty drawback. We filed the duty drawback on 20th April, but by that time we were knowing that now the department is having discretionary power to give us duty drawback. In other words, inflow of resources is only probable. If you had filed within the window period of 15 days, then duty drawback was confirmed. It was confirmed that we will definitely get the duty drawback. But because you fail to file within the stipulated time period, now you may get duty drawback, you may not get duty drawback. You know what happens? This becomes like a probable inflow of resources. You may get it, you may not get it. That is what is happening over here. A possible asset is getting created over here, and possible assets are nothing but contingent assets. Ind AS 37 says that contingent assets cannot be recognized in books. All that you can do is you can disclose it, provided the inflow of resources is probable. That means it is having a probability of more than 0.5. We should treat duty drawback as a contingent asset. And if you say it is a contingent asset, you cannot recognize that in your statement of profit and loss. Rather, you should be treating it as an item only to be disclosed. But then someone may counter argue that, come on, before the financial statements were approved, we have got the duty drawback. Shouldn't we consider this as an adjusting event? Okay, adjusting event means you can take a credit to the P&L before the financial statements are approved. Now, what is the position of Ind AS 37? As on 31st March, right, as on 31st March, duty drawback is representing a contingent asset. But before I approve my financial statements, I have already received the duty drawback. Hence, can I treat it as an adjusting event and take a credit for the same? What is the position taken by Ind AS 37 over here? Ind AS 37 says that you should continuously assess contingent assets. If the status of the contingent asset is changing, then the asset and its related income should be recognized by us. But Ind AS 37 says that it should be recognized as an income in the period in which such change occurs. I'll bring your attention to the contingent assets that we had discussed earlier. And this is the point that I really want you to focus on. Right, this is the point on which this question has been set. They are saying that contingent assets should be assessed continuously to ensure that developments are appropriately reflected in the financial statements. If it has become virtually certain that an inflow of resources of economic benefits will arise, the asset and the related income are recognized in financial statements. But read what is there in the bold. Of the period in which the change occurs. What does that mean? It means a contingent asset which later on is getting confirmed should be recognized as an income, but it should be recognized as the income in the period in which the change occurs, not for the period that it is related to. It is the inflow of resources is now confirmed after the balance sheet date. It should be recognized as an income of the next year, right? We shall go through the response. In the instant case, the condition of exceeding the specified turnover was met at the end of the reporting period, and the company was entitled for the duty drawback, but the application for the same has been filed after the stipulated time. Therefore, credit of duty drawback is discretionary. Discretionary means I may get it, I may not get it, right? At the hands of the department. Accordingly, the duty drawback credit is a contingent asset as at the end of the reporting period, which may be realized if the department credits the same. You know, we are at the mercy of the department now. The department may credit it, may not credit it, and that's the reason we are treating it as a contingent asset. As per Ind AS 37, a contingent asset should be recognized in the financial statements of the period in which the realization of the asset becomes virtually certain. In accordance with the above, the duty drawback credit, which was contingent asset for financial year 2021-22, should be recognized as asset, and related income should be recognized in the reporting period in which the change occurs. That is the period in which the realization becomes virtually certain, which is nothing but the next accounting year. Although it is an item of 2021-22, but its realization was confirmed in 2022-23, and hence it is an income of 2022-23. Insofar as the financial statements up to 31st March 2022 reported as a contingent asset. If you are confident that its realization is probable, then you can disclose it as a contingent asset. X Sugars Limited has entered into a sale contract of 3 crores with Y Chocolates Limited for the supply of sugar during 2021-22. As per the contract, the delivery is to be made within 2 months from the date of contract. In case of failure to deliver within the schedule, X Sugars Limited has to pay a compensation of 30 lakhs to Y Chocolates Limited. There's a sale contract of 3 crores with Y Chocolates Limited. And within 2 months from the date of the contract, the delivery is required to be provided. And in case if you are failing to stick to the schedule, you will end up paying a penalty of 30 lakhs to the other party. Then they are saying during the transit, the vehicle carrying the sugar met accident and X Sugar Limited lost the entire consignment. It is, however, covered by an insurance policy. According to the report of the surveyor, the amount is collectible subject to the deductible clause, that is 15% of the claim in the insurance policy. The cost of the goods lost was 2 crore 50 lakhs. As we had seen it earlier in the earlier para, you are supposed to supply sugar worth 3 crores of rupees, but your entire consignment has been lost because of an accident. You are now covered by an insurance policy. You have filed for an insurance claim. 85% of the claim will be released. They are saying 15% of the claim is going to be having a deductible clause. That means you will not receive it. 85% is what you will receive, and 85% will be received not of your selling price. 85% will be received for your cost. Before the financial year end, X Sugars Limited received informal information from the insurance company that their claim had been processed and the payment had been dispatched for 85% of the claim amount. Meanwhile, Wild Chocolates Limited has made demand of 30 lakhs of rupees since the goods were not delivered on time. The other party to whom you had promised sugar worth 3 crores, because you lost the consignment in accident, you have not been able to fulfill the requirement of the contract on time. You had already decided it earlier. In such a situation, a compensation of 30 lakhs is payable. The other party is demanding that compensation. What provision or disclosure would X Limited need to make at the year end? There are basically two issues over here. One is with respect to the insurance claim, where we are hopeful of getting 85% of 2 crore 50 lakhs. And the second issue is, what about 30 lakhs which is payable to the other party? Let's first discuss about this 30 lakhs to the other party. What do you say? Are the conditions for recognition of provision getting fulfilled over here? What are those three conditions? The entity should have a present obligation on account of a past event. The past event over here is that we have not been able to deliver the sugar as per the schedule. Do you have a present obligation? If the past event occurs, we are having an obligation of compensating the other party by 30 lakhs of rupees. I believe the first condition is getting satisfied. Is it probable that there shall be an outflow of resources embodying economic benefits? The answer is yes. And finally, the third condition is, can we measure it reliably? You know it very well, 30 lakhs is payable. A provision for rupees 30 lakhs should be recognized for the compensation that is payable to the other party, that is White Chocolates Limited. Okay, what about the insurance claim? Now, you know, for insurance claim, there are certain choices of words on which you will have to concentrate. They are saying that before the financial year end, I'm reading this particular, para. They are saying that before the financial year end, X Sugars Limited received informal information. You know, you are getting informal information maybe from the marketing executives of the insurance department that, see, we have processed your claim and very soon you will receive 85% of the cost of 2 crore 50 lakhs, the cost of the consignment of sugar that you have lost. Informal information. Is it a contingent asset, or is it an asset whose realization is 100% sure, that is virtually certain? Now, because the choice of the word is informal, you know, it means we have not received anything in writing, let us say, from the insurance company, which makes us believe that yes, there is sufficient evidence that it is virtually certain. It's only informal. You know, you may call up the insurance company, they may say that yes, everything is in order, very soon you will be receiving the money. They are saying payment has been dispatched, but informal information. I do not have anything concrete in hand to show that its realization is absolutely certain. What does that mean? If the realization is not absolutely certain, then the inflow of resources may occur, may not occur. This will make it a possible asset. It is a contingent asset. And if it is a contingent asset, provide disclosure for the same. Do not recognize that in your financial statements. I am giving a lot of importance to the term informal information over here. As per the standard where an inflow of economic benefit is probable, an entity should disclose a brief description of the nature of the contingent assets at the end of the reporting period, and where practicable, an estimate of their financial effect measured using the principles set in Ind AS 37. X Sugars Limited would need to disclose contingent asset of 2,12,50,000. How has that been calculated? The cost of the consignment of sugar that you have lost is 2,50 lakhs, and there is a deductible clause of 15%. You are getting 85% of it at the end of the financial year. It will also need to make a provision of 30 lakhs towards the claim of Y Chocolates Limited. Provision will be recognized for the full amount of 30 lakhs, but the insurance claim which has been informally passed fails to be recognized in our accounting books because we don't have concrete evidence which will show that its realization is virtually certain. You will disclose it as a contingent asset. During the year, QA Limited delivered manufactured products to customer K. The products were faulty, and on 1st October 2021, customer K commenced legal action against the company, claiming damages in respect of losses due to the supply of the faulty product. Upon investigating the matter, QA Limited discovered that the product was faulty due to defective raw material procured from supplier F. Therefore, on 1st December 2016, the company commenced legal action against F, claiming damages in respect of the supply of defective raw materials. There seems to be a chain of events over here, right? You have supplied a faulty product. Your customer K is filing a case against you. You are investigating that what exactly did go wrong. You realize that your product became faulty because the raw material supplied by your supplier F was defective. You are also starting proceedings against your supplier. Your client is starting proceedings against you, and you are initiating proceedings against your supplier. Okay. QA Limited has estimated that its probability of success of both the legal actions, the action of K against QA Limited and action of QA Limited against F, is very high. Possibility of success, they are saying. There is a very high chance that your client will win the case against you, and also a very good chance that you will win the case against your supplier. Okay. On 1st October 2021, QA Limited has estimated that the damages that it would have to pay would be rupees 5 crores. This estimate was revised to 5.2 crores as on 31st March 2022 and rupees 5.25 crores as at 15th May 2022. This case was eventually settled on 1st June 2022 when the company paid damages of 5.3 crores to K. Okay, a lot of figures are there here. This is basically for the damages that you will have to pay to your client. Okay, they are saying that you will have to pay 5 crores. On 1st October 2021, you will have to pay rupees 5 crores. Then they are saying 31st March. Okay, on 31st March 2022, this has increased to 5.2 crores. And then on 15th May, it has become 5.25 crores. 15th May 2022, you now feel that no, I will have to pay 5.25 crores. And finally, it is settled on 1st June 22 when you end up paying rupees 5.3 crores. Okay. On 1st December 2021, QA Limited has estimated that it would receive damages of rupees 3.5 crores from F. This estimate was revised to 3.6 crores as of 31st March 2022 and rupees 3.7 crores on 15th May 2022. This case was eventually settled on 1st June 2022 when F paid 3.75 crores to QA Limited. Just as earlier the figures were given for the possible outflow of resources, now they have given you probable figures for inflow of resources. We have filed a case also against our supplier F, and they have given us the figures for the same. Okay. Finally, they are saying that QL Limited had in its financial statements for the year ended 31st March 2022 provided rupees 3.6 crores as the financial statements were approved by the Board of Directors on 26th April 2022. On 26th April 2022, your financial statements got approved. Okay. What does that mean? They have given you the figures on 15th May and 1st June. Your financial statements are getting approved on 26th April. Figures on 15th May 2022 and 1st June 2022 make no sense at all. These are basically events which are occurring after the financial statements were approved. I cannot treat them as adjusting events. Hence, forget about 5.25 crores and forget about 5.3 crores. The only figure that matters is your estimate on the reporting date. You should be recognizing a provision for 5.2 crores. Why a provision? Because all the three conditions for recognition of provision are getting fulfilled over here. There is a past event. What's the past event? Your client, your customer has taken you to court because of supply of faulty product. And because the matter is lying in the court, you are having a present obligation. Is it probable that there shall be an outflow of resources embodying economic benefits for the settlement of the obligation? The answer is yes. We know that either we'll have to pay 5 crores on 1st October, and by the time it is 31st March 2022, it is 5.2 crores. And finally, the third condition is definitely getting satisfied. The amount of obligation is can be reliably estimated. Since all three conditions are getting satisfied, I should be recognizing a provision, and I will recognize a provision for 5.2 crores. The other issue is of the probable inflow of resources, right? It is this particular para. You have filed a case against your supplier. You want compensation from your supplier, right? This is an inflow of resources. When it is an inflow of resources, you have to be careful. We can recognize inflow of resources as our income only if its collection is virtually certain. Here they are saying that we have estimated, okay, on 1st December, we have estimated that we will get 3.5 crores. Then 3.6 crores on 31st March 2022. Then 3.7 crores on 15th May. And finally, when the case is getting settled, you are receiving 3.75 crores. Eventually, you are winning the case and eventually you are receiving the compensation from your supplier. But what matters is its status on 31st March 2022. On 31st March 2022, the judgment of the court is not yet out. In other words, the inflow of resources is not 100% confirmed, or I will say that the inflow of resources is not virtually certain. They haven't given us any concrete information by which we can be 100% sure that its realization is virtually certain. And hence, this possible inflow of resources is representing a probable asset. When you say it is a possible asset, it's a contingent asset. Contingent assets cannot be recognized in our books, but yes, you can definitely provide a disclosure for the same if its collection or if its inflow is probable. Probable means it must carry a probability of more than 0.5. Okay. Disclosed as a contingent asset, when you prepare it on 31st March 2022, you can show a contingent asset of 3.6 crores. Okay, what exactly are the questions? They are saying, one, whether the company is required to make provision for the claim as per the applicable Ind AS. If yes, please give the rationale for the same. You will have to recognize the provision. We have already discussed the entire rationale earlier. All three conditions are getting fulfilled. Yes, 5.2 crores is the amount of the provision that we should be recognizing. Whether the company is required to make a provision, our answer will be yes. You are recognizing a provision. Tell me, what will be your accounting entry to recognize a provision? Profit and loss account debit to provision, isn't it? and we have to record it with 5.2 crores. Here I have an amount with 5.2 crores, here 5.3 and here 5.25, isn't it? The moment you say that 5.2 crores is to be recognized, P&L will be debited. Here also P&L is debited, here also P&L is debited, here also P&L is debited. But only one accounting entry is there with 5.2 crores. You will say statement of profit and loss account debit to current liability account 5.2 crores. Actually, it should be P&L debit to provision for damages payable, but fine, provision for damages ultimately will be reported as a current liability. And in 3, they are saying what will be the accounting treatment of action of QA against the supplier F as per the applicable Ind AS. Ind AS 37 will be only applicable over here. There is a good chance of winning the case, but it is not virtually certain. And that is the reason I cannot credit my P&L with the expected compensation from the other party. Treat it as a contingent asset. Yes, QL Limited is required to make a provision. We have already discussed this. There is a present obligation, right? There is an event that you have supplied faulty goods. It is probable that there will be an outflow of resources, onboarding economic benefits. You can estimate that at 5.2 crores. Recognize the provision. Statement of P&L debit to current liability, that's your accounting entry. And as per Ind AS 37, QL Limited shall not recognize a contingent asset, only disclosure. Here the probability of success of legal action is very high, but no concrete evidence which makes the inflow virtually certain. But because the probability of winning is high, inflow of resources is probable. When inflow of resources is probable, contingent asset needs to be disclosed. They are saying hence it will be considered as contingent asset and shall not be recognized. When we say shall not be recognized, that means we will not record any accounting entry. The related income will not stand credited to the P&L. In the next year, when the verdict of the court is out and you have actually received the compensation, at that time you can credit the P&L. See, when we are recognizing a provision, one of the first conditions that we consider is that there should be a present obligation on account of a past event. When we say present obligation, the obligation can be a legal obligation or a constructive obligation. Legal obligation arises on account of some contract or on account of some statute, or it may be also on account of some processes of law. Now, it is quite possible that you will be found liable not as per the existing legislation, but because of a legislation which is soon going to be enacted. You know, most of the times this is what the government does. If they are planning any new law or any new legislation, first of all, that legislation will be proposed. You know, it will be put in the public domain. They will ask for inputs from different stakeholders, and after the inputs are received, then they will finally enact the same. It is quite possible that the government has already announced its desire to bring a new legislation. And when this new legislation will be formed, you are going to be found liable for certain obligations, for events which have already occurred in the past. Should I consider enactment of such new legislation for the purpose of deciding whether an obligation is existing, and if yes, whether a provision should be recognized or not? We are taking a very special situation over here, which is with respect to enactment of legislation, which is virtually certain. You know, virtually certain. Only formality is left. As I said, the government has already announced the proposed law. Already debate is going on in public domain as well as in the parliament. Very soon it will become an actual law. In other words, it will become a legislation. And the moment it will become a legislation, you are going to be found liable. Should I recognize a provision for it, or should I counter argue that this is not a law till as of now, and because it is not a law as of now, I will not recognize any provision? Ind AS 37 says that, see, when a new legislation is, the enactment of new legislation is virtually certain, it should be considered for the purpose of determining a provision to be recognized. Hence, whenever you are recognizing a provision, do not consider only the existing law, also consider the legislations which are virtually certain. Okay, as I said, if it is already in public knowledge that very soon a new law is going to be enacted and it is a mere formality, debate is going on, but then let's say the central government is having majority in the parliament, more or less it is only a formality, they are only discussing it. We know it will soon be passed by the parliament, it may go to the Rajya Sabha, and from there it will go to the president. Mere formalities are going on, ultimately it will become an actual act. If such new legislation is going to find you liable for certain activities that you have done in the past, you should recognize a provision considering the new legislation. We say enactment of new legislation is virtually certain. Effect of possible new legislation should be taken into consideration in measuring an existing obligation when sufficient objective evidence exists that the legislation is virtually certain to be enacted. Will this new legislation find you liable for certain obligations? Please go ahead and recognize the provision. When the enactment is virtually certain. Okay. Then they are saying that the variety of circumstances that arise in practice makes it impossible to specify a single event that will provide sufficient objective evidence in every case. It is not necessary that every time a new law is going to be put in public domain, at times the government can bring new legislations out of the blue. You are not expecting it and they may bring a new legislation. Okay. Evidence is required both for what legislation will demand of and whether it is virtually certain to be enacted and implemented in due course. What is the requirement of the legislation? You should be virtually certain with respect of it, and whether its enactment is also certain. And once it is enacted, as we know, provision has three requirements. You may have a present obligation. You may have a probability of outflow of resources, but what if I cannot accurately measure it? Because it's going to be implemented in the due course. When the legislation will be implemented, what will be the amount of the obligation for me? At times, you may not even be certain about it. In such a situation, I will not recognize a provision. In many cases, sufficient objective evidence will not exist until the new legislation is enacted. What they are really trying to say is, if the enactment of the new legislation is virtually certain and all the conditions given in Ind AS 37 for recognition of provision are getting satisfied, you should recognize a provision. Enactment of new legislation is not virtually certain, no need to recognize provision. Enactment of new legislation is certain, virtually certain, but I cannot estimate what will be the amount of the obligation. In that situation also, I will not recognize a provision. In short, on case-to-case basis, you should decide what should be the stand to be taken by the company. X Chemicals Limited, engaged in the chemical industry, causes environmental damage by dumping waste in the river near to its factory. It does not clean up because there is no environmental legislation requiring cleaning up, and X Chemicals Limited is causing damage for the last 40 years. That's a very sorry state of affairs which are there in our country. We know it very well. There is this company engaged in the chemical industry since last 40 years. It has been polluting a nearby flowing river. Why? Because no environmental legislation required the cleaning up of the river. Okay. As at 31st March 2022, the state legislature has passed a path-breaking legislation requiring all polluting factories to clean up the river water already contaminated. The formal gazette notification of the law is pending. How should X Chemicals Limited deal with this situation? The state legislature has already passed this new legislation, but it has still not been notified in the official gazette. Technically, I can argue it is still not a law. But don't you feel that this is just a mere formality? Now that the state assembly has already passed the legislature, it is a mere formality that it is going to be notified. We can say that the enactment of the new legislation is virtually certain. And you know what will happen because of the new legislation? You will have to clean up the river. Is that a past event? You have been polluting the river since last 40 years. That's the past event. Present obligation is the obligation for cleaning up the river. Condition number 1 for recognition of provision satisfied. Is it probable that there shall be an outflow of resources embodying economic benefits? The answer will be yes. Can you reliably estimate the same? Answer will be yes again over here. You should call in the experts and the expert will give you an estimate that this is how much it is going to cost. Even though it has not been notified in the official gazette, but because the law is virtually certain, we should recognize a provision, because the conditions for recognition of provision which are given in Ind AS 37, those conditions are getting satisfied. The obligating event is the contamination of water, and because of the virtual certainty of legislation requiring cleaning up, an outflow of resources is certain. It is possible to arrive at the best estimated cost for the cleanup activity. A provision should be recognized in the books of X Chemicals Limited. Right, although it has not become a law as yet, but because its enactment is virtually certain, you are soon going to be found liable for all the contamination that you have caused in the last 40 years. Make a provision for the best estimate of the cost for cleaning up the river. Many times you can have contracts where an expenditure that has been incurred by you will be either fully reimbursed by the other party or partially reimbursed. This is what is going to give rise to a separate asset, a reimbursement asset, provided of course its realization is virtually certain. Remember, if the realization is not virtually certain, then at the end of the day it is representing an inflow of resources. But if its collection is not virtually certain, then it will become a contingent asset. We already know what to do with contingent assets. Contingent assets cannot be recognized in financial statements. However, if the inflow of resources embodying economic benefit is probable, that is having a probability of more than 0.5, then a disclosure of contingent asset can be given. Reimbursement asset should be distinguished from a contingent asset. I have an enforceable agreement by which I can recover either entirely or partially from you an expenditure incurred by me. If that is so, then its collection is virtually certain. When inflow is virtually certain, it is not a contingent asset. I will treat it as a reimbursement asset. As a special situation, we are discussing reimbursements where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party. The reimbursement should be recognized when and only when it is virtually certain that reimbursement will be received if the entity settles the obligation. The reimbursement should be treated as a separate asset. Since they are saying its realization is virtually certain, that's the reason we are not writing over here that reimbursement is representing a contingent asset. It's an actual asset. The amount recognized for the reimbursement should not exceed the amount of the provision. In the statement of profit and loss, the expense relating to a provision may be presented net of the amount recognized for a reimbursement. Let us say I have to incur an expenditure of 10 lakhs. Hence, I should recognize a provision for 10 lakhs. That's the first thing that we understand. But then I realize that out of 10 lakhs, 6 lakhs is recoverable from you and it is virtually certain. Hence, 6 lakhs of rupees will be treated as a reimbursement asset. And along with that, I will also recognize an income of 6 lakhs. But instead of showing income of 6 lakhs separately, I can deduct 6 lakhs from the amount of provision that I had recognized. The provision that I had recognized was of 10 lakhs. Instead of showing in my P&L 10 lakhs, I will say it is 10 lakhs minus 6, 4 lakhs of rupees. That's what they are saying in the last one, that in the statement of profit and loss, the expense relating to the provision may be presented net of the amount recognized for a reimbursement. Beauty Solutions Limited is selling cosmetic products under its brand name B, but it is getting its product manufactured from Y Limited. It has an understanding, they are saying enforceable agreement with Y Limited, that if the company becomes liable for any damage claims due to any injury or harm to the customer of the cosmetic products, 30% will be reimbursed to it by Y Limited. During the financial year 21-22, a claim of rupees 30 lakhs becomes payable to customers by X Beauty Solutions Limited. How should X Beauty Solutions Limited account for the claim that becomes payable? 30 lakhs of damages are payable. For 30 lakhs of provision should be recognized. 30% of that will be reimbursed, and they will use the word enforceable agreement. 30 lakhs into 30% turns out to be 9 lakhs. Rupees 9 lakhs will be rupees 9 lakhs represents a reimbursement asset, which should be treated as a separate asset. But yes, in the P&L, when I will show an expense of 30 lakhs, from that 30 lakhs, I can deduct the expected income from the reimbursement asset of 9 lakhs. I can show a net debit to the P&L of rupees 21 lakhs. 30 lakhs minus 9 lakhs. Since the understanding results in an enforceable agreement, the reimbursement of rupees 9 lakhs shall be recognized as a reimbursement right, and provision will be recognized for rupees 30 lakhs. Okay, the reimbursement right shall be treated as a separate asset and shall not be offset with the provision. In the statement of profit and loss, the expense may be presented as rupees 21 lakhs after offsetting the reimbursement asset. Getting it? Provision of 30 lakhs will be shown. Say it is damages payable, right? I will say profit and loss account has to be debited ultimately. So we will say provision for damages is to be recognized. So P&L debit to provision 30 lakhs. A reimbursement asset will be debited to the related income of rupees 9 lakhs. Now, P&L is to be debited by 30 lakhs and P&L is to be credited by rupees 9 lakhs. Hence, the net expense that I can debit to my P&L is 21 lakhs of rupees. Earlier, when we were discussing the scope of Ind AS 37, at that time we had discussed a point that Ind AS 37 will not be applicable to executory contracts. But if the executory contract is an onerous contract, then Ind AS 37 is applicable. And in that very discussion, we had gone through what do we mean by an executory contract and what do we mean by a contract that has become onerous. In short, onerous contract is not a new term for us because we have already introduced ourselves to these kinds of contracts, as I said initially when we discussed the scope of the Ind AS 37. If I take you to that write-up of the scope of Ind AS 37, Ind AS 37 should be applied by all entities and accounting for provisions, contingent liabilities and contingent assets except, look at the first one, those resulting from executory contract except where the contract is onerous. In short, Ind AS 37 is applicable to an executory contract in case if the executory contract is an onerous contract. And that's what I was saying, that then at a great length we had discussed what is an executory contract and we had also discussed what is an onerous contract. That point of onerous contract is repeating again. When can we say that the contract has become onerous? many a times you may enter into a binding contract. Binding contract means it's a non-cancelable contract. And after you have signed the non-cancelable contract, certain events which are not in your control occur. And then you realize that when you will give the performance of this binding contract, there are certain unavoidable costs, but those unavoidable costs are exceeding the benefits which are expected to be derived. You know, the cost of implementing the project or the cost of implementing the contract may be 10 lakhs, while the benefit that you will get will be only 9 lakhs. When the cost is exceeding the benefit, we say that the contract has become onerous. And you should recognize a provision for the loss that you are going to suffer. We say an onerous contract is a contract in which the unavoidable cost of meeting the obligations under the contract exceed the economic benefits expected to be received under it. The present obligation under an onerous contract should be recognized and measured as a provision. Ind AS 37 applies to executory contracts that are onerous. Of course, this is where the meaning of the onerous contract is, where the unavoidable cost of meeting the obligation is exceeding the expected benefit to be derived from the contract. Consider the contract to be an onerous contract. For example, in the earlier days, petrol prices and the diesel prices were still not deregulated. Petrol and diesel prices were actually decided by the government. Okay. Now what would happen is, if the crude oil prices are rising, then the petrol price will start rising in India. And many a times the government will step in and will say that no, petrol price cannot cross so and so level. What happens is, although the refinery is having a cost of petrol, let us say at rupees X, it was forced to sell at a price which is below X because of the government regulation. So when the government is regulating the petrol prices and even the diesel prices, this is what was happening in the earlier days. The oil refining companies will sell petrol and diesel at a price which is below its cost and suffer a loss. We can say that the contract has become an onerous contract. Or let us say you are a pharma company. The government decides that this is the medicine that you are producing. It has to be sold at a fraction of your cost. The government is saying that, see, this medicine that you are producing, we are classifying it as a life-saving drug. And because it is a life-saving drug, it should be affordable to the poorest of the poor of India. And that is the reason you will have to sell this medicine at a price below what is its cost. This will also make a contract an onerous contract. And if the contract has become an onerous, whatever is your expected loss, it should be provided for. You know, this is what we mean by an onerous contract. Respond based on Ind AS 37. Yes, certain onerous contracts are given or may not be given. We'll have to first check, is it an onerous contract? And if yes, what should be its treatment? X Metals Limited has entered into a non-cancelable contract with Y Limited to purchase 10,000 units of raw material at 50 per unit at a contract price of 5 lakhs. As per the terms of the contract, X Metals Limited will have to pay rupees 60,000 to exit the said contract. For example, you want to set aside the contract, you want to resign the contract, you will have to pay damages or a penalty, we can say, of 60,000. X Metals Limited has discontinued manufacturing the product that would use the said raw material. For that, X Metals Limited has identified a third party to whom it can sell the said raw material at 45 rupees a unit. How should X Metals Limited account for the transaction in its books in respect of the above contract? You have entered into a contract to buy 10,000 units of raw material from the other party at 50 rupees per unit. In other words, you will have to pay 5 lakhs of rupees. This raw material is required for manufacturing a certain product. But what has happened now is you have discontinued that product itself. And because you have discontinued the product, you do not require the raw material. Okay, if you do not require the raw material, then set aside the contract. If you exit the contract, you will have to pay a penalty of 60,000 rupees. Alternatively, you have identified another party to whom you can sell the same raw material at 45 rupees per unit. You will buy at 50 rupees and sell at 45, incur a loss of 5 rupees per unit. 10,000 units, that means you will incur a loss of 50,000 rupees. Don't you feel that the contract has become onerous for you? See, it was a non-cancelable contract. Hence, I will have to compulsorily buy 10,000 units from you and then have to sell it at a loss. Or alternatively, I can refuse to take the delivery of 10,000 units and pay 60,000 rupees of penalty to you. Now, if I decide to set aside the contract, I'll have to pay 60,000 rupees of penalty. And if I buy 10,000 units from you at 50 rupees and sell it to a third party at 45, I shall suffer a loss of 50,000 rupees. Tell me, what should I do? Should I suffer a loss of 50,000 or pay a penalty of 60,000 to you? It's very natural, isn't it? You will go for executing the contract, incur a loss of 50,000. But one thing has become clear. The unavoidable cost of implementing the contract is 5 lakhs, while the benefit to be derived is 4,50,000. Cost is exceeding the benefit. This makes the contract an onerous contract. The expected loss of 50,000 rupees should be provided for. These circumstances do indicate an onerous contract. The only benefit to be derived from the purchase contract costing 5 lakhs are the proceeds from the sale contract, which are rupees 4,50,000. Therefore, a provision should be made for the onerous element of 50,000, being the lower of the cost of fulfilling the contract and the penal cost of cancellation of 60,000. Either incur a loss of 50,000 or pay a penalty of 60,000. Obviously, a rational person will go for the lower of the two. And hence, we will provide 50,000 rupees. An entity has entered into a contract to purchase specific quantity of coal at the rate of rupees 50 per unit over a period of 3 years. The contract is not cancelable without payment of compensation. The current market price of coal is 45 rupees per unit. The coal is purchased for consumption during the manufacturing process, the output of which is sold in the market at a profit. Is the contract an onerous contract? You will have to buy coal at 50 rupees a unit, although it is available in the market right now at 45 rupees per unit. Does this make the contract an onerous contract? Are you buying coal for a trading purpose? If you are buying coal for a trading purpose, then yes, the contract has become an onerous contract. I have a long-term contract to buy coal from you at 50 rupees. I trade in coal. What I will buy at 50, I'll have to sell at 45. Committed cost is 50. And the expected benefit is 45. Cost is exceeding the benefit. That means it is an onerous contract. It is an onerous contract, as I said, provided you are trading in coal. But here coal is purchased for consumption during the manufacturing process. We are buying coal for consumption purpose, not for trading. Finally, once the output will be ready, the output will be sold at a profit. If you are selling the output at a profit, that means the higher cost of coal which you are paying of 50 rupees a unit is ultimately getting recovered. I hope you get my point. Agreed, I am buying coal at an extra payment of 5 rupees per unit. Agreed. But I am not trading in it. It will just become a part of my consumption process. I will manufacture the final product and the final product is sold at a profit. Hence, the extra 5 rupees that I am paying per unit of coal ultimately is getting recovered. That means the benefit is exceeding the cost. And if the benefits are exceeding the cost, such contract is not an onerous contract, isn't it? No, the contract is not an onerous contract because the entity will derive economic benefits from the contract, including the benefit of using the coal in the manufacturing process, and the final product will be sold at a profit. I am buying expensive coal, but I will enjoy the benefit. First, I will use it for my consumption purpose, and then I will sell the final product at a profit. Entity XYZ entered into a contract to supply 1000 television sets for rupees 2 million. An increase in the cost of inputs has resulted into an increase in the total cost of sales to rupees 2.5 million. The penalty for non-performance of the contract is 0.25 million. Is the contract onerous and provision in this regard required? You have entered into a contract to supply 1000 television sets for 2 million. Your expected benefit is turning out to be rupees 2 million. And now you realize that the cost of sales will be 2.5 million. Cost of sales, this will be 2.5 million. The cost is exceeding the benefit to be derived, and when the cost exceeds the benefit to be derived, the contract becomes onerous. If you execute this particular contract, you will suffer a loss of 0.5 million, isn't it? And if you do not give performance of the contract, you have to pay a penalty of 0.25 million. Either I will suffer a loss of 0.25 million or a loss of 0.5 million. Obviously, I will go for 0.25 million. Is the contract onerous? Two questions are there. Is the contract onerous? Answer is yes. Is a provision required? Answer is yes. Provision will be required for 0.25 million. You should recognize a provision for the penalty that will be payable because of the non-performance of this contract. In the instant case, cost of fulfilling the contract is rupees 0.5 million and cost of exiting from the contract is by paying a penalty of 0.25 million. In accordance to Ind AS 37, it's an onerous contract as cost of meeting the contract exceeds the economic benefits. Provision should be recognized as the best estimate of the unavoidable cost, which is lower of the cost of fulfilling it and any compensation or penalties arising from the failure to fulfill it. That is at rupees 0.25 million. 0.25 million and 0.5 million, we are selecting the lower of the two. Sun Limited has entered into a binding agreement with Moon Limited to buy a custom-made machine for rupees 4 lakhs. At the end of 2017-18, before the delivery of the machine, Sun Limited had to change its method of production. The new method will not require the machine ordered, which is to be scrapped after delivery. The expected scrap value is nil. Given that the asset is yet to be delivered, should any liability be recognized for the potential loss? If so, give reasons for the same, the amount of liability as well as the accounting entry. They have given as a case of Sun Limited and the case of Moon Limited, right? Sun Limited has entered into a binding agreement with Moon Limited to buy a custom-made machine. Moon Limited will provide the machine. Sun Limited will have to pay the necessary consideration, which in this example is 4 lakhs. At the end of 2017-18, before the delivery of the machine, Sun has changed its method of production. And because you have changed your method of production, you do not require this machine at all. But to begin with, they have made it very clear it is a binding agreement. Because it's a binding agreement, whether you require the machine, yes or no, you still have to execute the contract and get the machine. Once the machine will be received, it will be scrapped. and it will be scrapped at a scrap value of 0. You're not expecting anything. Now just see, they are saying before the delivery of the machine. You know what that means? It means Moon has not delivered the machine and Sun has not made any payment. In other words, the performance of obligation for both the parties to the contract are pending. This will make it an executory contract. You know, this is an executory contract. Executory contract is a contract where neither of the two parties to the contract have provided any performance of their obligation, or they have partially performed but at an equal rate. Here, Sun has not made any payment, Moon has not delivered the machine. None of the parties to the contract have performed their obligations. It is an executory contract. Ind AS 37 is not applicable to executory contract. Okay, you cannot apply Ind AS 37 to executory contract. However, if you come to the conclusion that the executory contract has become an onerous contract, then Ind AS 37 will become applicable. Is this an onerous contract? Sun Limited does not require this machine any longer, but it is a binding contract. I do not require the machine, still I will have to take the delivery of the machine, still I will have to make the full payment. Once I receive the machine, I will have to scrap it, and the scrap value is 0. The unavoidable cost of meeting the obligation of the contract is rupees 4 lakhs and the expected benefit is 0. Unavoidable cost is exceeding the benefit to be derived. That makes it an onerous contract. If the executory contract is an onerous contract, Ind AS 37 becomes applicable. You will have to recognize a provision for the loss that you are expecting of rupees 4 lakhs. As per Ind AS 37, executory contracts are contracts in which neither party has performed any of the obligation, or obligations are performed partially to an equal extent. The contract entered by Sun Limited is an executory contract since the delivery has not yet taken place. Ind AS 37 is applied to executory contract provided they are onerous. Ind AS 37 defines an onerous contract as a contract in which the unavoidable cost of meeting the obligation on the contract exceed the economic benefits expected to be received from it. As per the facts given in the question, Sun Limited will not require the machine ordered. Since it's a binding agreement, the entity cannot exceed or cancel the contract. Further, Sun has to scrap the machine after delivery at nil scrap value. These circumstances do indicate that the agreement or the contract is an onerous contract. A provision should be made for the onerous element of rupees 4 lakhs. Your accounting entries are over here. Onerous contract provision expense account debit to provision for onerous contract liability account, and then this onerous contract provision expense account debit will be transferred to the profit and loss account. Profit and loss account debit to onerous contract provision expense account. So there are different layers here. We realize it's an executory contract. Then we realize Ind AS 37 is not applicable to executory contract, but it does become applicable if the executory contract is onerous contract. We do realize it's an onerous contract, hence we apply Ind AS 37 and recognize a provision. Okay. The onerous contract provision expense account is debited to onerous contract liability account, and the onerous contract expense is finally debited to the profit and loss account. Can we recognize provision for future operating losses? Think about it. When we are saying that we want to recognize the provision, Ind AS 37 is laying down 3 conditions. Condition number 1, if you will analyze condition number 1, there and there itself, you will get the answer to the question. We say there should be a present obligation on account of a past event. Present obligation. The moment you say future operating losses, that means this is something for which you will be liable in future. And if you are going to be liable for future, it does not satisfy the recognition criteria of Ind AS 37. And if the recognition criteria are not satisfied, obviously there is no question of recognizing a provision. They say future operating losses do not meet the definition of a liability and the general recognition criteria set for provisions as specified in the standard. Ind AS 37 does not permit recognition of provision for future operating losses since they do not stem from a past event. There has to be a past event because of which there has to be a present obligation. Future operating losses is something that will happen in future. It's a new development. You cannot recognize provision for the same. The principles which are laid down are Ind AS 37 are not really like the principle of conservatism. The principle of conservatism is future operating losses should be provided for, isn't it? We say future probable gains should be ignored, future probable losses should be provided. This is something that has been ingrained in our minds insofar as the principle of conservatism is considered. That is not so how Ind AS 37 has been formulated. Ind AS 37 provides certain conditions, and on fulfillment of those conditions only you can recognize a provision. Future operating losses should be ignored by us. An expectation of future operating losses is an indication that certain assets of the operation may be impaired. An entity should test these assets for impairment under Ind AS 36. If you are of the view that there will be operating losses in future, is the cause of the future operating losses because your assets are of subpar quality? If that is so, then there may be a possibility of impairment. You should apply Ind AS 36 and provide for the impairment loss, but we will not recognize a provision for the future operating losses. X Packaging Limited has two segments, Packaging Division and Paper Division. In March 2021, the Board of Directors approved and announced a formal plan to sell the Paper Division in June 2021. Operating losses of the Paper Division are estimated to be approximately Rs 50 lakhs during the period 1st April 2021 to the expected date of disposal. Management of X Packaging Limited wants to include the future operating losses of 50 lakhs in a provision for restructuring in the financial statements for the period ended 31st March 2021. Can X Packaging Limited include these operating losses in a provision for restructuring? You are having two divisions, Packaging Division and Paper Division. You have decided to close the Paper Division. In March 2021, you have already taken this decision. But from 1st April 2021, that is from the next accounting year, till the actual date of disposal, we are expecting a loss of Rs 50 lakhs. You have decided to close this division. You know that you will close this division and yet you will suffer from a loss of 50 lakhs. We want to recognize a provision for this future operating loss. Can we recognize this provision? You already know the answer. Future operating losses cannot be provided for. We cannot recognize this provision. Standard states that provision should not be made for future operating losses. Since Ind AS 37 prohibits the recognition of future operating losses, X Packaging Limited should not include these future operating losses in a provision for restructuring, even though these losses relate to the disposal group. Disposal group is something that is a part of Ind AS 105. Ind AS 105, it deals with non-current assets held for sale and discontinued operations. In Ind AS 105, we have studied that there is something known as assets been held for sale, or it can even be a group of assets held for sale, which will be understood as a disposal group. But even if it is a disposal group, the loss is not for the current period. The loss is for a future period. You cannot recognize loss for a future period in the current year. Ind AS 37 has given specific guidance with respect to how provisions should be recognized in the event of a corporate restructuring. First and foremost, let us understand how is restructuring understood under Ind AS 37. It says that restructuring is a program that is planned and controlled by management and materially changes either manner in which the business is conducted or the scope of the business undertaken. Right? We are saying it is something planned and managed by the management, and it is going to alter the way we are doing business, or it will alter the scope of the business. Restructuring can take the following forms, right? Restructuring can be in form of sale or termination of a line of business. You are no longer interested in a particular business. You want to sell that or terminate that business. The closure of the business locations in a country or region, or the relocation of business activities from one country or region to another, right? You are having multiple business locations, you are shutting down certain locations, or you are moving from one location to another. Doesn't matter whether it is in the same country or it is across different countries, it can still be considered to be a restructuring. Actually, this A and B, right? You have this A and B. It can also classify as a discontinued operation. Discontinued operation is basically a subject matter of Ind AS 105. The title of Ind AS 105 is Non-Current Assets Held for Sale and Discontinued Operations. Discontinued operation means there is some major line of business or a major geographical area from where you are withdrawing, or it can even be a subsidiary which you are selling. You can consider that as a discontinued operations. So a slight overlapping of the Ind AS. A and B will also fall part of restructuring as understood in Ind AS 37, and it will also be understood as a discontinued operation under Ind AS 105. Ind AS 105 is only dealing with disclosures. Hence, if you are doing a restructuring which is also getting classified as discontinued operation, the disclosures required will be given as per Ind AS 105. But the provisions to be recognized, that will be done on the basis of Ind AS 37. Then C, they are saying changes in management structure, for example, eliminating a layer of the management. You may have managers, then you have assistant managers, then you have senior managers, then you have top level managers. You know, this is the hierarchy that you are maintaining in management. You decide all of a sudden that we do not want any assistant managers now. You will have managers, and then directly you'll have senior managers. You are just eliminating one entire layer of management. This can also be considered to be restructuring. And finally, in D, they are saying fundamental reorganizations that have a material effect on the nature and focus of the entity's operations. Fundamental reorganization. For example, you are planning what is popularly known as a demerger. You may argue that isn't part A also demerger? Yes, it can be a part of demerger. When you sell a particular business or you terminate a business, it can be understood as a demerger. But what if you are yourself floating a new company and transferring your business to that new company? You can go for splitting of your company. You have 3 businesses and you split your entire company into 3 companies where each company will manage a particular business. This is a very fundamental reorganization that you are doing, popularly known as a split off, a spin off, or a demerger. What are the provisioning requirements? They are saying a provision for restructuring costs is recognized only when the general recognition criteria for provisions are met. General criteria, those 3 conditions should get fulfilled. Only then you can recognize a provision. There should be a present obligation, legal as well as constructive obligation on account of a past event. It is probable that there shall be an outflow of resources embodying economic benefits to settle the obligation, and you can reliably estimate the amount of the obligation. If all the three conditions, which is nothing but the general criteria for recognition of provision, are getting fulfilled, you shall recognize a provision for a restructuring. Yes, we know that when you say present obligation, it includes both legal as well as constructive obligation. We had discussed about constructive obligation in the past. What do we understand by a constructive obligation? A company, because of its actions, can create valid expectations that it will accept certain responsibilities, and for those responsibilities you will then have to recognize a provision. You are not legally required to do so, you are not statutorily required to do so, you are not contractually required to do so, but you are creating valid expectations through your actions. Those valid expectations means certain responsibilities will be accepted by us. That is what is going to give rise to a constructive obligation. Similarly, there can be a constructive obligation even for a restructuring. We want to know how that constructive obligation will be arising. Right, this is something that we had discussed in the past with respect to provision. I just want to draw your attention to constructive obligation. Here it is. We have discussed this earlier. A constructive obligation arises from the entity's actions through which it has indicated to others that it will accept certain responsibilities, and as a result has created an expectation that it will discharge those responsibilities. This is also something that is giving rise to a present obligation on account of a past event. Your action, which is signaling that certain responsibilities will be accepted by you, will become the past obligating event, and it will give rise to a present obligation. If the other two conditions are also getting satisfied, you need to recognize a provision. In a restructuring exercise, how will you give rise to a constructive obligation? They say a constructive obligation to restructure arises only when an entity has a detailed formal plan for the restructuring, identifying at least. You have already prepared a detailed formal plan. Minimum of minimum, it has identified the business or part of the business concerned. Which business are you planning to sell or terminate, or what part of the business will be discontinued? The principal locations which are going to be affected. If you are having, let us say, factories in 3 different states, and one of the factory I have decided to shut down, I should know which is the location that will be affected. The location, function, and approximate number of employees who will be compensated for terminating their services. Obviously, if you are selling or terminating a part of your business, or you are eliminating one entire level of management, there are certain employees who are going to get affected. The expenditures that will be undertaken, and when will the plan be implemented, and the second point, has raised a valid expectations in those affected that will carry out the restructuring by starting to implement that plan or announcing its main features to those affected by it. In short, when will you have a constructive obligation with respect to restructuring? You have a detailed formal plan. Okay, you have a detailed formal plan, and you have raised a valid expectations in those affected that you will implement that plan, or if you not implement the plan, you have at least announced that particular plan. You may have started discussions. For example, you have not started implementing the plan. You have decided to shut down a particular business. You are ready with a formal plan, but you have not implemented it. But you are calling a meeting of the employees who are going to get affected, and you start communicating to them that, see, this is the business that we are planning to shut down, and hence you are going to be affected. If you are going to be affected, are you planning to provide them some retrenchment compensation? Are you planning to absorb them in some another unit of yours? Whatever it is. Discussions have already started. You have started taking actions by which you are creating valid expectations amongst others that certain responsibilities will be assumed by you. This is what is giving rise to a constructive obligation. Within the parameters of Ind AS 37, you may have to recognize a provision. Finally, the main point now, what are the provisions to be recognized? They are saying Restructuring cost provision will include and exclude the following. Includes only the direct expenditure arising from the restructuring that are both necessarily entailed by restructuring, not associated by the ongoing activities of the entity. You will recognize provision only for those expenses which are necessary to implement your formal plan of restructuring. Okay? Whatever expenses are there, they should be necessarily entailed by restructuring. It should not be associated by the ongoing activities of the entity. If it is an ongoing activity of the entity, then it is nothing but an operating expense. It should be directly debited to the P&L. There is no need for me to create a provision for the same. More important is what is not going to be included. Retraining or relocating the continuing staff. Okay. You are retraining your continuing staff or you are relocating your continuing staff. This will not become a part of the reconstructioning cost provision. You should treat this as an operating expense and debit the P&L. Marketing expense. Are you doing any marketing? You cannot recognize a provision. Or investment in new systems and distribution networks. These three items shall be excluded from the reconstruction cost provision. X Siemens Limited has 3 manufacturing units situated in 3 different states of India. The board of directors of X Siemens Limited in their meeting held on 10th January 2021 decided to close down its operations in one particular state on account of environmental reasons. You are operating in 3 different states and you have decided to shut down your operations in one particular state. Right, moving from one location to another or shutting down certain major locations of your business will turn out to be restructuring. A detailed formal plan for shutting down the above unit was also formalized and agreed by the board of directors in that meeting, which specifies the approximate number of employees who will be compensated and expenditure expected to be incurred. Date of implementation of plan has also been mentioned. Meetings were also held with customers, suppliers, and workers to communicate the features of the formal plan, to close down the operations in the said state, and representatives of all interested parties were present in those meetings. Do the actions of the board of directors create a constructive obligation that needs a provision for restructuring? Are your actions giving rise to a constructive obligation? We have already discussed this. When will a constructive obligation be arising? When you are doing 2 things. You have a detailed formal plan for the restructuring. If you check with the case that they have given, we have formalized a detailed plan. We have identified the locations which are going to be affected. We have identified the parties which are going to be affected, isn't it? Hence, A is getting fulfilled. And in B, they are saying, has raised a valid expectation in those affected that it will carry out the restructuring by starting to implement the plan. We have still not started implementing the plan, but we have announced the main features to those who are affected by it, isn't it? We have already conducted meetings. If you see the case now, we have started doing meetings with our customers, suppliers, workers, and we are communicating to them that what are the features of the plan. Our actions are making it very clear that we are accepting certain responsibilities, and those responsibilities may be required to be discharged by settlement of an outflow of resources. They are saying, do the actions of the board of directors create a constructive obligation? The answer is yes. You are giving rise to a constructive obligation. As per Ind AS 37, the conditions prescribed are there should be detailed formal plan of restructuring, which should have raised valid expectations in the minds of those affected that the entity would carry out the restructuring by announcing the main features of its plan. The board of directors did discuss and formalize a formal plan of winding out the operation in the above said state. The plan was communicated to the parties affected and create a valid expectation in their minds that X Cements Limited would go ahead with its plan to close down the operations in that state. Thus, there is a constructive obligation that needs to be provided at the year end. They haven't given us any list of expenses that we are expected to incur. Fine. Hence, we are not in a position to say that these expenses will be provided for and these will not be. But is there a constructive obligation? The answer will turn out to be yes. Within the parameters of Ind AS 37, restructuring cost provision will be recognized for those items for which it is permitted. U Limited is a large conglomerate with a number of subsidiaries. It is preparing consolidated financial statements as on 31st March 2022 as per the notified Ind AS. The financial statements are due to be authorized on 15th May 2022. It is seeking your assistance for some transactions that have taken place in some of its subsidiaries during the year. G Limited is a wholly owned subsidiary of U Limited, engaged in management consultancy services. On 31st January 2022, the board of directors of U decided to discontinue the business of G Limited from 30th April 2022. They made a public announcement of their decision on 15th February 2022. You are having a wholly owned subsidiary G Limited, you are engaged in management consultancy services and you have decided to discontinue this particular business. They are saying we will discontinue the business of G Limited from 30th April 2022. The moment you are deciding to sell or terminate a business, it will be considered to be a restructuring within the understanding of Ind AS 37. Not only that, it will also be considered to be a discontinued operation as understood in Ind AS 105. The title of Ind AS 105 is Non-Current Assets Held for Sale and Discontinued Operation. If you are withdrawing from a major line of business, which indeed is happening over here, we will consider it as a discontinued operation. Now, discontinued operation, you have to provide separate disclosures under Ind AS 105. If you recall the format of your P&L. What is the format of the P&L? Try to recall. First, you will be reporting revenue, then other income, then the total income, then expenses. Then you will be showing profit before tax and exceptional items, then a head for exceptional items. Then you will say profit before tax, then tax expense, which is broken down into current tax and deferred taxes. And then you have profit after tax. But when you write profit after tax, you say profit after tax from continued operations. And then we are having certain heads for discontinued operations. I hope you are able to recall the format of the P&L. For discontinued operations, you will be showing what will be the income, expenses, what is the tax impact, and then you will find out the profit after tax from discontinued operation. And then the PAT from continued operations and PAT from discontinued operation will be aggregated, and that sum total will be reported as the profit for the period. Isn't it? These separate disclosures that you are giving for the discontinued operation is as per Ind AS 105. Okay. They are saying that we are going to discontinue it on 30th April 2022. You are finalizing on 31st March 2022, while it will be classified as a discontinued operation on 30th April 2022. That means it will affect the year 2022-23. The announcement is made on 30th April 2022. 30th April 2022, Ind AS 105 will become applicable. And hence I will consider it as a discontinued operation for the year 2022-23. As far as the current year is considered, right, the current year is 2021-22, we will consider it to be a part of your continued operations. In other words, whatever is the income and expenses for the management consultancy services, when you prepare CFS, you will carry out a line by line addition, as a part of your continued operations. Do not treat it as a discontinued operation right now, because the announcement has not happened within the current year. Announcement has happened in the next year. However, that will not stop us from recognizing provision for the restructuring, provided the conditions of Ind AS 37 are getting fulfilled. Okay. Let us discuss further what else is there in the question. G Limited does not have many assets or liabilities, and it is estimated that the outstanding trade receivables and payables would be settled by 31st May 22. U Limited would collect any amount still owed by G Limited's customers after 31st May 2022. They have offered the employees of G Limited termination benefits or alternative employment opportunities. Okay. Following are some of the details relating to G Limited. On the date of public announcement, it is estimated by G Limited that it will have to pay 540 lakhs as termination payments to the employees, and the cost for relocation of employees who would remain within the group would be rupees 60 lakhs. Okay. We are planning to pay some termination benefits. Termination benefits. Of some 540 lakhs, and there will be certain relocation costs of 60 lakhs. Okay. And then they say the actual termination payments totaled 520 lakhs were made in full on 15th May 2022. As per the latest estimates made on 15th May 2022, the total relocation cost was 63 lakhs. Actual expenditure turned out to be 520 here and 63 over here. Okay. Then they say that G Limited had taken a property on operating lease which was expiring on 31st March 2026. The present value of the future lease rentals using an appropriate discount rate is 430 lakhs. On 15th May 2022, G Limited made a payment to the lessor of 410 lakhs in return for early termination of the lease. You are terminating the lease prematurely. Your lease was up to 31st March 2026, but you have decided to discontinue the business on 31st March 2022. If I have already decided to discontinue the business, I do not require the lease to continue any further. If the lease is not expected to continue further, then ideally I should not be making any payments. Think of it. Let us say you have taken a factory on lease up to 31st March 2026. But after 31st March 2022, let's say I am in no need of that factory. I will like to return the factory back to the lessor, and I will like to discontinue the payment of the lease. Isn't it? If I am not using the factory or if I am not using the asset, then why should I pay lease payments? It seems that this lease agreement was a non-cancelable lease agreement. And because of that, you are forced to pay 410 lakhs to the lessor. The committed cost of the contract is 410 lakhs, and against that, you are not going to get any benefit at all. You know, earlier I was paying lease rent, and in return, I was getting the right of using the asset. I was using the asset, that was the benefit, and against that, there was a cost. That is understandable. But here you are incurring a cost, but against that, you are not getting any benefit at all. Don't you feel that this contract has become an onerous contract? Isn't it? And it is a settlement of an onerous contract. And we know under Ind AS 37, we do recognize provisions for onerous contract. I am given over here an onerous lease contract. Right, I was supposed to pay 430 lakhs, but we have been able to settle it down for 410 lakhs. Looking further into the case that has been given to us, the loss after tax of G Limited for the year ended 31st March 2022 was 400 lakhs. G Limited made further operating losses totaling 60 lakhs till 30th April 2022. Up to 31st March 2022, there is a loss of 400 lakhs that will definitely become a part of the current year's financial statements. Okay, but you are expecting to make further operating losses of 60 lakhs till 30th April 2022. 60 lakhs of further operating loss is expected. This is nothing but a future operating loss of 60 lakhs. Future operating loss of 60 lakhs is one more item given to us. Okay, what are the questions now? How should U Limited present the decision to discontinue the business of G Limited in its consolidated statement of comprehensive income as per the Ind AS? How should we present this? We have already understood this, that on 30th April 2022, it will get classified as a discontinued operation, and hence it should be reported as a discontinued operation in the year 2022-23. Because the announcement is done on 30th April 2022, I will classify this as a discontinued operation, and as per Ind AS 105, once it becomes a discontinued operation, after that, whenever you are preparing a financial statement, you should include it as a discontinued operation. Do not treat this as an adjusting event and counter argue that that the conditions relating to it were existing as on the reporting date, and hence I will treat it as a discontinued operation also for the current year. Your line of argument is valid, but Ind AS 105 says that, see, once a business is classified as a discontinued operation, disclosures at discontinued operations should be provided from that financial statements which are prepared after it was classified as discontinued operation and not before that. Hence, we cannot treat this as an adjusting event. What does that mean? It means the year that you are preparing, right? You are preparing your financial statements for the year 2021-22. You will consider it to be a continued operation. You will do line by line addition. They are saying consolidated statement of comprehensive income. Comprehensive income, that's nothing but the statement of profit and loss. In your consolidated statement of profit and loss, you will do line by line addition of the parent's operations and the subsidiaries operations and make it a part of your continued operations. And then they are also saying what are the provisions that the company is required to make as per Ind AS 37. A decision to discontinue the business is not simply a discontinued operation. It is also becoming a restructuring exercise. And to the restructuring exercise, I will have to apply Ind AS 37. Okay. Restructuring will actually take place on 30th April 2022. But if you have any constructive obligations as on 31st March 2022, then you should make a provision for that constructive obligation. Constructive obligation for a restructuring exercise arises when you have prepared a detailed formal plan and you have made an announcement of it, or you have started doing discussions with respect to the same with the parties that are getting affected. Here we have definitely started making discussions with our parties, isn't it? We are having discussions with our customers. We are having discussions with our employees. Here it is. We will like to know that for what items can we recognize a provision, and if yes, at what amount? Restructuring cost provisions. Here it is. I'll just clear it up. What will be included and what will be excluded? Okay. Direct expenditures arising from the restructuring that are both necessarily entailed by the restructuring and not associated by the ongoing activities. And whatever are the expenses relating to the ongoing activities, you cannot recognize a restructuring cost provision for the same. Yes, here we are. Termination benefits. Should I recognize a provision for the termination benefits? Is the termination benefits payable to the employees on account of the restructuring? Answer is yes. And is it relating to the ongoing activities? No. The moment I will pay the termination benefits, my employees will leave the organization. Now they are not associated with my organization. Both the conditions are getting fulfilled. Termination benefit is an expenditure that you are incurring which is relating to the restructuring and not relating to your continuing activities. I should recognize a provision for termination benefits. Should I recognize a provision for 540 lakhs or 520 lakhs? See, our earlier estimate was 540 lakhs, but it becomes 520 lakhs. That is your actual expenditure, which we are incurring on 15th May 2022. 15th May 2022 appeared earlier also over here. Our financial statements will be approved on 15th May 2022. Before the approval of the financial statements, we get the actual figure of the termination benefits. We should consider this as an adjusting event and accordingly recognize a provision for 520 lakhs. The fact that you were supposed to pay the termination benefits was known on the balance sheet date. The actual amount is getting confirmed after the reporting date. It is providing us evidence of circumstances that were prevailing on the balance sheet date, and hence we should adjust our financial statements. In case if you had originally recognized a provision for 540 lakhs, you should update it to 520. And if you have not recognized any provision at all, recognize the provision for 520 lakhs. What about the relocation costs? Should I recognize a provision for the relocation costs? Is the relocation cost of the employees because of restructuring? Answer is yes. Is it relating to, it should not be related to continuing activities. If your employees are getting relocated, then they will continue in your group and hence this expense will be relating to your continuing activities. Please understand, when you are recognizing a provision for restructuring cost, two conditions should be fulfilled. It should be relating to restructuring and it should not be relating to the continuing activities. When you are analyzing relocation costs of the employees, first condition is getting fulfilled. It is relating to restructuring, but it is also related to the continuing activities. Because of that particular reason, I cannot recognize any provision for the relocation cost. Okay. Onerous lease contract. We know Ind AS 37 is applicable to the onerous contract and you should recognize a provision for the same. I will recognize a provision. I will recognize a provision for 410 lakh. I was supposed to pay 430, but the settlement is happening at 410. I'll pick up the lower of the figure, which is 410. Future operating losses. Future operating loss. The moment you say the word future, there and then itself it is becoming clear that I cannot recognize a provision. I can recognize a provision only when there is a present obligation on account of a past event. Here there is no past event. This is something that will happen in future. We will not recognize a provision for the future operating loss. In other words, you will recognize a provision for 520 and 410. If I take a total, it is turning out to be 930 lakhs. I shall recognize a total provision of 930 lakhs for the restructuring exercise. A discontinued operation is the one that is discontinued in the period classified as held for sale at the year end. The operations of G Limited were discontinued on 30th April 2022 and therefore would be treated as discontinued operation for the year ending 31st March 2023. As we had discussed, the announcement is made on 30th April 2022. It will become a discontinued operation for the next financial year, or we can say the next accounting year. As far as the current year is considered, it is a continued operation. It does not meet the criteria for held for sale since the company is terminating its business and does not hold these for sale. Accordingly, the results of G Limited will be included on a line-by-line basis. Why line-by-line basis? Because you are preparing consolidated financial statements in the consolidated statement of comprehensive income as a part of profit from continuing operations for the year ending 31st March 2022. Okay. Now Ind AS 37. Restructuring includes sale or termination of a line of business. A constructive obligation to the restructuring arises when an entity has a detailed formal plan for restructuring and you have raised valid expectations in those affected that it will carry out the restructuring by stating to implement that plan or announcing its main features to those affected by it. The Board of Directors of U Limited have decided to terminate the operations from 30th April 2022. They have made a formal announcement on 15th February 2022, thus creating a valid expectation that termination will be implemented. This creates a constructive obligation and requires restructuring provision. A restructuring provision includes only the direct expenditures arising from the restructuring that are necessarily entailed by the restructuring and are not associated with the ongoing activities of the entity. The termination payments fulfill the above condition. As per Ind AS 10, events after the reporting date, events that provide additional evidence of conditions existing on the reporting date should be reflected in the financial statement. Therefore, we will recognize a provision for 520 lakhs. The relocation costs relate to future conduct of the business and are not liabilities for restructuring at the end of the reporting period. Hence, these would be recognized on the same basis as they arose independently of restructuring. Right, treat it as an operating expense and you can debit your P&L. The operating lease would be regarded as an onerous contract. A provision would be made at the lower of the cost of fulfilling it and any compensation or penalties arising from the failure. Hence, a provision shall be made for 410 lakhs. Further, operating losses relating to future events do not form part of a closure provision. Therefore, a total provision of 520 lakhs plus 410 lakhs 930 lakhs is required. You will recognize a provision for 930 lakhs. As you can see, that's the same thing that we had calculated earlier. 520 plus 410, 930 lakhs. See, at the end of the day, a provision is an accounting estimate. Accounting estimates will keep on changing as new information and new evidence is available. That is what we shall be doing also with a provision. Once a provision has been recognized, you should continuously assess the provision. You should continuously evaluate the evidence that is available on the basis of which a provision was recognized in the first place. We know as per Ind AS 37, you should recognize a provision if it is probable that there shall be an outflow of resources. It's quite possible that a new development occurs and because of that, the outflow of resources is no longer probable. If the outflow of resources is no longer probable, then whatever provision that you had recognized earlier, that provision needs to be reversed. Similarly, it is also very much possible that now the outflow of resources is 100% confirmed. Please understand this. We understand provision as a liability of uncertain timing or uncertain amount. But once the timing or the amount has become 100% certain, then it should no longer be considered to be a provision. Of course, it is still a liability, but the classification of the liability should change. For example, let us say there is a pending lawsuit. Your lawyers have advised you that most probably you will lose this particular case and be prepared to pay 50,000 rupees of damages. Hence, I have recognized a provision for rupees 50,000. In my balance sheet, as a part of current liability, I am saying provision for damages payable 50,000. Now the verdict of the court is out and the court has ordered me to pay 60,000 rupees. First and foremost, I will have to update the amount of the provision, which earlier I had recognized as 50,000. Now I will say it is 60,000. But now you should not use the word provision for damages payable. Now the exact amount of damages payable is known. Instead of provision for damages payable, rather show it directly as damages payable 60,000. Whenever a reader of the financial statement reads provision for damages payable, the user of the financial statement is evaluating this as an expected expenditure, as an accounting estimate. When I read the word provision before the damages payable, as a user, I am of the view that this is nothing but an accounting estimate. It may change in future. But because the judgment of the court is already out and I know that exactly 60,000 rupees is payable, don't say provision for damages payable. Write directly damages payable 60,000. When I read only damages payable, it becomes very clear to my mind that this is an amount which is now confirmed. For example, when we are buying on credit basis goods worth 60,000 rupees, we are not saying provision for amount payable to the creditors, right? Directly we will show it as a part of our trade payables because it is 100% confirmed that this is the amount which is to be paid. Within the liability section of your balance sheet, necessary adjustments should be made to make it clear to the users of the financial statements that now the amount that we have provided for is no longer uncertain. It is a certain amount of outflow of resources embodying economic benefits. We'll just read what we have discussed, then we will discuss the third and the final point over here. They are saying that provisions should be reviewed at the end of each reporting period and adjusted to reflect the current best estimate. If it is no longer probable that an outflow of resources embodying economic benefits will be required to settle the obligation, provision should be reversed. Once the amount of the obligation is crystallized and there is no uncertainty associated with an obligation, the liability is no longer a provision. We understand provision as a liability of uncertain timing or amount. Timing is certain now and the amount is also certain. It is no longer a provision. It does not mean it is no longer a liability. It still remains a liability. Classification internally should change. The same should be reclassified as an element within the liabilities. Now, many a times you are using discounting as a technique to measure the provision. Ind AS 37 says that where the effect of time value of money is material, provision should be discounted and presented in the financial statements at their present value. But you must understand that as we are moving 1 year closer to the final settlement of the obligation, the previous year discounting should be reversed. To that extent, the provision should be increased. This increase in provision on account of the unwinding of the previous year's discounting should be treated as a borrowing cost in our books. Try to recall the treatment of the decommissioning liability that we had understood as a part of Ind AS 16. In Ind AS 16, we were dealing with decommissioning liabilities. We know that when you are calculating the cost of the PPE, the cost of dismantling the asset or the restoration of the site, which will be incurred much later, its initial estimate will be included in the cost of the PPE. By initial estimate, we mean its present value. And then as you are moving 1 year closer to the final settlement of the decommissioning liability, previous year's discounting needs to be reversed. Even in Ind AS 16 also, the increase in the provision for the decommissioning liability, it was treated as an interest cost, as a finance cost, as a borrowing cost. Exactly the same we shall be doing also under Ind AS 37. Where discounting used, the carrying amount of the provision increases in each period to reflect the passage of time. This increase is recognized as a borrowing cost. X Telecom Limited has income tax litigation pending before the appellate authorities. Legal advisor's opinion is that X Telecom Limited will lose the case and estimated that a liability of 1 crore may arise in 2 years. The liability is recognized on a discounted basis. The discount rate at which the liability has been discounted is 10%, and it is assumed that discount rate does not change over the period of 2 years. How should X Telecom Limited calculate the amount of the borrowing cost? Any increase in the provision thanks to the unwinding of the previous year's discounting should be treated as a borrowing cost. Okay. You are supposed to settle the litigation liability of 1 crore in 2 years, and you have decided to use 10% as the discount rate. Second year present value factor at 10% will be used for the purpose of discounting. Okay. One crore will be discounted at a present value factor at 10% for second year. Getting it? Which is actually 0.826, which will give us 82,60,000. At the end of the current year, we have to settle this obligation 2 years from now. Hence, I am discounting it at the second year present value factor, and I realize it is 82,60,000. I will recognize a provision for 82,60,000. Okay, this is what we will be doing as on today, right? As on today. Now, at end of first year, what will happen? At the end of first year, 1 crore is payable, but now it is payable 1 year from now. When you see it from today's viewpoint, 1 crore was to be settled after 2 years. And that is the reason we discounted at the second year present value factor. Once 1 year comes to an end, now you see from the viewpoint of end of first year, now only 1 year is left for the final settlement. And the first year present value factor hence needs to be used. I should discount this at now 10% first year. That means 1 crore will be discounted at 0.909. This is turning out to be 90,90,000. The provision that you had shown in the previous year at 82,60,000 should be increased to 90,90,000. Okay, it should be increased to 90,90,000. Hence, I will work out the difference. The difference is turning out to be 8,30,000. This is the increase in the provision. This is what should be treated as a borrowing cost. Right, this will be your borrowing cost for the first year. When the first year comes to an end, you will debit your P&L by 8,30,000. Getting it? So this will be the increase in the provision of 8,30,000. Your accounting entry will be borrowing cost account debit to provision. See, provision was earlier recognized at 82,60,000. That provision should increase to 90,90,000. Provision is a liability. It has a credit balance. Liability is to be increased. That means the liability needs to be credited. Hence, my accounting entry will be whatever I may debit, but I will have to credit the provision. So I will have to say to provision account 8,30,000. Borrowing cost account debit, or you can even say interest cost account debit to provision, and then ultimately interest cost will be debited to the P&L as a part of the borrowing cost. So this was the comparison that we have done, and we have provided for 8,30,000. What will happen at the end of second year now? Understand? End of second year. Now no discounting is required. It is already time for to make the final payment, and hence I will have to now require a balance of 1 crore as a provision. You have recognized till now 90,90,000, which should now become 1 crore. Okay. This is giving me a difference of 9,10,000. I am comparing 1 crore with 90,90,000. You already have provision of 90,90,000. Now the provision should be 1 crore. This increase in the provision of 9,10,000 is also the borrowing cost. This is the borrowing cost for the second year. Okay. 9,10,000. Interest cost account debit to provision 9,10,000. And finally, the provision which was originally 82,60,000 has become equal to 1 crore. Workings I have already discussed with you, right? You should provide 82,60,000, then 90,90,000. You are increasing it by 8,30,000. That's your borrowing cost. At the end of the second year, the liability should be 1 crore. It is already 90,90,000. Increase it by 9,10,000. 9,10,000 will be recognized as a borrowing cost in the second year.